Good morning, everybody. Welcome back to another episode of the Market Open. It is Friday, April 4th. We are at the end of the first trading week of Q2. It is indeed Friday. And, well, if you looked at your portfolio this morning, it is quite similar to yesterday, which is that it's red. But it is not only just red, it is a continuation of the red that we have seen after the Trump Liberation Day tariffs went into place on April 2nd. And today it's red because of one major headline that I'm not going to waste any time, and I'm going to show on the screen right now. I woke up to this news. Some of you might not know that this is happening. Some of you guys probably already saw that this indeed is the case. China has announced a 34% import tariff against all U.S. goods starting on April 10th. The S&P 500 fell 2.5% in the pre-markets. That actually was down about 3.2% at one point. It had a slight recovery based on non-farm payrolls that we'll talk about in a second. It is now down 12% year to date. Another set of individual stocks are down pretty much 5 to 8%. Those high beta growth stocks. Jerome Powell, in about 2 hours, will be speaking. We'll be covering it live, and boy, am I curious to see what the heck Jerome Powell has to say. Tesla is down 5%. JPMorgan, one of the biggest banks in the world, down 4%. Bank of America, down 5% after falling 11% yesterday. SoFi, below $10, down 7%. Broadcom, down 4%. Palantir, down 3%. Robinhood, down 6%. Micron, down 4%. Nike, down 5%. Shopify, down 5%. Meta is $4 away from going below 500. Again, the S&P 500, 524. At the lows, we were at 515, which imagine that is $15 away from below 500. I mean, imagining the S&P 500 with a 4 handle is kind of insane to think, but it is the reality that we are living in right now. Nvidia is at $98. At one point, it was $95 in the pre-market. This one is now below 100. It was down 7% yesterday. It's down another 3% right now. Pretty much the bottom, I would say, is falling out of all of these stocks. And this is what we're seeing in real time. The NASDAQ right here down 19% peak to trough, down another 2.85% right now, 437.95. Amazon is down. Grab is down. Hims is down. Royal Caribbean is down. Alibaba is down. Reddit's down. Rock Lab's down. Pretty much everything is bleeding red. And it's bleeding red based on this headline around China. This is one of those things where it's just it's not even that it's tough seeing this happen. It's tough seeing this happen because of how avoidable it seems like it was. AKA, you could have done tariffs. No one's saying you can't do tariffs. It's just the way in which this was imposed, quite frankly, has been, in the words of Dan Ives and Tom Lee yesterday, absurd. And that's what we're experiencing right now. The VIX as well is almost at 40. I mean, if the VIX hits 50 today, the one silver lining there is that hopefully that's a bottom signal if the VIX is spiking up that dramatically. I mean, it tends to say that's max fear when that happens, but obviously we're going to have to see how it plays out. The VIX was up yesterday. It wasn't up as aggressively as it is right now, so we'll see kind of how this plays out. But this is bad. This is bad right now, and obviously the market is reflecting that this is bad based on how they are showing you what they believe equity prices should be. Now, why is this happening? First of all, I'm gonna have Chris join me in about, I think, 5 to 10 minutes. He's getting ready, and he'll be on long for the show today, so he'll be able to help us break down some analysis in regards to what's happening. So we'll try to get some other perspectives here. Fear and greed is at 6 right now. VIX is at 45. In terms of the short summary on what's happening right now, in my opinion, what's happening is the market is saying we are very upset at the universal reciprocal half tariffs that Trump imposed 2 days ago. And we're not going to help equity prices go higher until we have some clarity, because that's creating a massive level of uncertainty across the entire economic spectrum. But not only is that upsetting the market, because that was good for 3% yesterday, what's good for another 3% in the pre-markets is the fact that now the market is trying to figure out, what does the retaliation look like? By the way, this is just China. We haven't had any retaliatory measures yet from Canada, the EU, some of our other largest trading partners, Japan, South Korea. I mean, we really haven't seen the extent to how bad this can get. We're only hearing from China right now. And that's why I think the bottom is falling out. Now, in my opinion, look, I do think there will be some deals that are made and there will be some level of negotiations, because at some point, I think also Trump is going to realize like this just can't go on forever. Maybe I'm wrong about that. We'll see how it plays out. I think if the entire U.S. stock market were to fall 30, 40, 50%, something is going to change. And so I don't know how long that's going to take. A lot of economists are of the opinion that these tariffs are not going to be imposed in the way that they've been introduced. But right now, the market, and this is what Trump said was going to happen. And so they're pricing it in to the worst extent. And the worst extent, at least for now, is S&P 500 down 12% year to date. If China were to actually announce a 34% import tariff, again, this is going into effect April 10th. That's giving it about a week to probably get negotiated if it actually does see the day of light. Then that would be bad. That'd be really, really bad. And if it would be really, really bad, then obviously equity prices. I mean, look, as bad as it looks right now in the stock market, it makes sense, right? It makes sense. There's no way you can't say it doesn't make sense. You can't. This is not one of those moments where you're like, oh, the market's emotional. The market doesn't get it. It's like, no, the market gets it. The market can handle crappy earnings growth. The market has handled crappy earnings growth across the board for about a century now. It's more so, can the market handle the uncertainty around what that earnings growth is going to look like? And I think it's going to be very hard for any company in Q1 to meaningfully give some type of guidance for what the hell is going to happen in Q2, unless we get some deals and negotiations in place over the next couple of weeks before Q1 earnings starts, which maybe will happen. But as of now, it doesn't look as likely. So that's the pain we're seeing in the stock market right now. Now, real quick, there's some big breaking news I want to share to you guys. But before we get to that, I just want to show you the jobs data, which also matters. And I'm sure we'll talk about it more, but it's obviously not as important as what's going on with these China tariffs. Non-farm payrolls, which was supposed to be the biggest news of the day. Now it's being hindered by the China stuff. But this stuff also is important in the context of job growth. 228,000 new jobs versus 140,000 expected. That's a big beat. That's a big, big beat. Non-farm payrolls, I mean, it's showing that the labor market is in a pretty good space. Now, what's not good about this is that obviously that means that inflation is probably going to still be sticky. The Fed is not going to be able to cut rates based on the fact that the labor market is doing as well as it's doing. Again, if you believe these numbers, then this is a really, really good beat in the context of what was expected. So now it's a question of, okay, we have these tariffs that are going to be inflationary. We have a labor market that's not slowing down. Unemployment went from 4.14 to 4.15. So technically it's 4.2%, but relatively unchanged as well. And then we have inflation that's not necessarily slowing down dramatically enough for the Fed to be like, all right, it's time to cut rates. Which means I think there's a world where you get a Fed that doesn't cut because they're afraid that if they do cut, it would create stagflation, given that the tariffs are probably going to be inflationary unless we get some deals on those tariffs before the next FOMC meeting, which is going to be May 19th. And that results also in the stock market feeling the pain, because if we're not pricing in any rate cuts, obviously the market's not going to like that either. So this is bad. This is bad. This is not the best thing in the world. Now, here's the big piece of breaking news. Has Fear and Greed ever hit 1? I think Fear and Greed hit 4 during COVID. Right now we're at 6. So I don't think we've ever hit 1 on Fear and Greed, or at least I've never seen it. But I think back in COVID, it was like 4 to 6. So we're basically at the COVID levels what we got when it comes to Fear and Greed. Okay, now here's the big piece of news. Here's the big piece of news. Yeah, Europe is crashing as well. I saw that. We'll talk more about the global markets here. So this is the biggest piece of news this morning that, well, I wonder what you guys are going to think about this. So this theory that, honestly, I got to give Chris credit to this. The first time I ever heard of it is Chris when he was on the show about a month ago saying, hey, Trump wants the stock market to crash because it creates all this volatility in the stock market, and that gets people to sell off stocks, buy bonds, and that allows the bond market to then have yields go down, which is good because that can get mortgage rates down, that can do this, that can do that. There's all of these benefits to refinancing the debt if the 10-year comes down. Well, the 10-year is now below 4% for the first time in about 5 months, 3.934. We are seeing that theory kind of happen, right? Which is that Trump is cracking the stock market in order to get bond yields to go down. And I know a lot of you hate that theory. You've made it very vocal to me over the past coming weeks that was like, admit this is a stupid theory. It doesn't make any sense. Well, Donald Trump just reposted this TikTok on his Truth Social. Take a look at this TikTok.
Trump is crashing the stock market by 20% this month, but he's doing it on purpose. And this is why Warren Buffett just said Trump is making the best economic moves he's seen in over 50 years. Now, here's the secret game he's playing, and it could make you rich. So why is he doing this? To push cash into treasuries, which forces the Fed to slash interest rates in May, and those lower rates give the Fed the ability to refinance trillions of debt very inexpensively. It also weakens the dollar and drops mortgage rates. Now, it's a wild chess move, but it's working. Now, you're probably wondering, what about his tariffs? Well, I'll tell you, it's a genius play. It actually forces companies to build here to dodge them. It also forces farmers to sell more of their products here in the US to bring grocery prices way down. We've already seen this with eggs. Now, remember, 94% of all stocks are owned only by 8% of Americans. So Trump, he's taking from the rich short term and handing it to the middle class through lower prices.
Okay, so Warren Buffett obviously did not say whatever this TikTok said that Warren Buffett said, but it's less about the truth of this TikTok. It's about the fact that he reposted it. It's about the fact that he reposted it. So when I saw this in the morning, this repost, that to me mattered way more than any of the other news that we got 32 minutes ago. You can see right there, if the camera focuses, Trump reposted that. So this whole idea that we've been talking about around, hey, Trump's crashing the market to get bond yields to come down. I'm not even saying this is the best economic theory. We had Tom Lee on the show yesterday who said, look, maybe he's doing this, but it's a really slippery slope that he's playing and a dicey game, because if you end up leading to a recession, it doesn't really matter if you've been crashing the stock market to refinance debt, because in a recession, everything kind of goes to shit. So I'm not saying this theory is like the best theory in the world. I'm just saying it is one way to kind of explain what's going on. The fact that he reposted that yesterday or this morning, to me, is him essentially confirming that this is what he's doing. Is that a good thing to do? Obviously, that's subjective. And, you got a lot of economists that probably think it's stupid to try to crash the market to get bond yields to come down. But the point is, that repost to me was an official confirmation by him or his team to justify in whatever convoluted way they want to justify that that is their plan. And you notice in the video, it says like Trump wants to steal from the rich and give to the poor, essentially saying Trump wants to take from people that have assets and make assets cheap, aka houses, so that people who are lower income or middle income can be able to afford those houses. This is a very base playing message, right? Because he's playing to his base of voters that are to an extent economically disenfranchised, and probably that's one of the reasons they voted for Trump. And as a result, he's saying, hey, look, I'm taking from people who have tons of money and I'm making things cheaper for you. Now, obviously, as investors, that screws all of us. And for the average American, that also screws them, because they have 401ks and the stock market falling is not good for them either. But the point is, that repost to me was an official confirmation that that's how he thinks about the nature of what's going on right now. And as a result, it is leading to the types of volatility that we're seeing right now in the stock market. S&P 500 right here down 2.27%. Again, we are a bit green from the absolute lows in the pre-market, which was about an hour ago. So we're seeing a little bit of momentum to the upside, but still a pretty bloody day. And when 9:30 kicks in and we get a lot more volume coming into the market, we'll have a better understanding of how this is playing out and what goes from there. Let's get an update specifically on these Chinese tariffs. So if you're just joining, that is the main headline for the day, 34% tariffs across the board. That is what is being introduced on all imports. And that is obviously part of the core reason for why the markets are getting hit here right now. Let me just pull this up. We'll have Chris joining us in a little bit to get his thoughts on everything. And then we will keep going from there.
Of them are more meaningful than others. So the first one that I think is the most important is that they said they're going to impose a 34% tariff on all U.S. imported products. That's going to be effective as of April 10th. The second one is that they said that they're suspending the imports from 6 U.S. agricultural companies that have to do with sorghum and also chicken and chicken-related parts. There are no names at this point of which ones they're. Oh, wait, I'm just getting one. 2 companies that export poultry products, Mountaire Farms of Delaware and Coastal Processing. The sorghum company is C&D of C&D Incorporated. So this is just coming out right now. The third one is an anti-dumping investigation into CT tubes and medical equipment. And then what's interesting is that they also are going to be tightening export controls for 7 types of rare earths. And it looks as though some of them are quite important in MRI and other medical related items, such as.
So the rare earth one was kind of a personal response by Beijing. So they're targeting 7 types of rare earth minerals, in addition to the 34% import tariffs. We know that Trump has that rare earth minerals deal coming up with Ukraine. This is kind of China saying, hey, if you want to play this type of ball, or if you want to play this type of game, then we're ready to play hardball. China knows how important rare earth minerals have been for President Trump. It's one of the core elements of this deal that he's trying to get done with Ukraine. So those announcements by China obviously are leading to a lot of pain right now. And the market's trying to price in how serious do they think China is versus how serious they think Trump is in the context of this stuff actually going into law. We have about a week until it officially goes into law, and then we'll have a better understanding of how markets want to price that in. Let's hear from the professor, get his thoughts, and then we'll keep going from there.
To get your wisdom in moments like this. You're often a calming voice. I don't know if you'll be a calming voice this morning, but as you see what's taking place with these tariffs, do you anticipate the market to turn around, or is this a falling knife that continues to fall?
Well, first, I want to pick up on what you said, Andrew, about the Smoot-Hawley tariff. I think this is the biggest policy mistake in 95 years. And what is interesting is on the Republican Senate's website. So if you go to senate.gov and look up tariffs, this is what they say. It was on June 13th, 1930, that the Senate passed the Smoot-Hawley tariff, describing it as among the most catastrophic acts in congressional history. Now, this is the Republican-controlled U.S. Senate. And it said, despite the fact that 1,000 economists wrote a letter to Hoover saying, veto it, he did not veto it. And then it goes on saying the results were, and to use their words, disastrous. So disastrous that the American public voted the Republicans out of the House, the Senate, and the presidency 2 years later. Now, to be fair, the Fed screwed up badly afterwards as the economy sunk as a result of this. And they're not going to do that again because they've learned that lesson. I don't know why Trump didn't learn the lesson of the Smoot-Hawley tariff, because I know the Fed learned the lesson of its mistakes in 1930, 31, and 32. That's one reason why the great financial crisis did not turn into a Great Depression. We flooded the banks with liquidity, which we did not do 95 years ago. But very honestly, I mean, they say it all. I wouldn't be surprised if President Trump scrubs this passage out of the website, because this is on the Senate Republican website.
Right.
The good.
Obviously, you can see Professor Siegel is not excited about this. The only good news is that bonds are taking a bit of a hit with the broader market. But pretty much across the board, you've got people understandably upset in regards to how this policy is playing out. Let's have someone join the show who's going to be with me for a good chunk of this show to kind of break down what's happening and try to make sense, if we can make any sense, of how this is playing out. Chris. Good morning, sir.
Man, it's crazy to see the markets going up and down like this. I mean, I think I would say I made a couple of mistakes on my portfolio allocation right now. I should have been a little bit more heavy on TLT, especially because we kind of knew what the playbook was going to be. It's not like we didn't know. The only thing is, yeah, I just wish I had taken a bigger stance on it. And the reason why I didn't go heavy on TLT is because I did not think the Trump administration would end up choosing the Lutnick route and go like full on crazy tariffs. Like, did you by any chance catch the BG2 podcast with Brad Gerstner and Bill Gurley?
I did not, but I can pull up any part of it that was important.
Yeah. The most important part was basically this thing between Scott Bessent and Howard Lutnick, right? It was two schools of thought. So if you can pull that part up, I think that's important because Brad Gerstner actually did a CEO roundtable last week, and they kind of like discussed some of this stuff. And I think it's very, very interesting to point out. And basically where the Trump team kind of like what direction they went in. This tends to always happen. You always have two schools of thought, and then usually one school of thought wins out, and the market is going to react to that school of thought. So with Scott Bessent, the school of thought was, hey, listen, let's do more moderate like tariffs, that the market and the other countries can kind of like pallet, like 10%, 15 and 20, and bracket them out and basically just be very, very mild with how we approach this. Whereas the Lutnicks of the world said, let's full on just go crazy with it. And so if you look at all the interviews that have been coming out, it's mostly been Lutnick at front and center trying to explain all of this stuff, Did you?
Yeah, and it's really, really interesting. So I have the clip right here, and we'll play it in a second. But I just want to get your quick reaction to kind of this China stuff, and how you think the market is reacting to it. So China's imposing 34% tariffs. Do you think it is right for the market to be down 2% right now, based on this headline?
I mean, yeah, tariffs are never good. It's not good for the country that's getting the stuff, and it's not good on the other side either. So there's no winners in a tariff war, right? So right now, the fact that China raised up its tariffs it's jarring. It's not something that we've experienced in the last 100 years, so that's why the market is like, doesn't know how to react. And one of the things that I tried to invest based on was that after this Liberation Day, we would get a little bit more market certainty. And I think with what happened, market certainty just kind of went out the door, because now you don't know what retaliatory tariffs are going to look like. Like China is the first one to do it. We don't know what the EU is planning. Then there's, of course, all these other countries that are going to have to, do something. So the market is right now just very uncertain. Now, uncertainty can be a good thing for bond yields, right? As you can see, bond yields are going down, which is what the Treasury Department actually want, which what Scott Bessent and the Treasury Secretary actually want, because this way they actually have a whole bunch of debt that maturity that they can actually term out at a more reasonable price. Trying to term out the debt at the current interest rates right now would be really bad, because then you'd have a rush of all this money going into the 10-year, and the 10-year could end up rising to like 4.5%, 5%. Now we've all of a sudden have to deal with this debt overhang for a lot longer. So the goal here is get interest rates to be as low as possible, and then term out the debt so that, we have a more manageable deficit.
So I think you saw the video that I sent you where Trump reposted. Basically, the first time I heard this theory that he's trying to crash the market to get bond yields come down was from you. And Trump reposted a TikTok video confirming that today.
Yeah,
which I think is pretty interesting.
I'm seeing all these people starting to say the same thing now. Bill Ackman said the same exact thing too, so a little bit of kudos to me for figuring it out early.
The funny thing is, like, I kind of get your theory as well, but we should have sold everything if that was right. But it's like, even we still didn't believe in our heart of hearts he would be that crazy to actually do it.
Yeah. Well, the thing is, like, we thought he would approach this with a moderate tone. I honestly thought Scott Bessent would end up winning out on the debate, but it wasn't Scott Bessent that won. Howard Lutnick that won that debate, and Trump went with that one, and now we're seeing the impacts of that. So, did you have that clip? Let's watch that real quick.
So it should be starting right here. All right, this is Brad Gerstner and Bill Gurley on how they're thinking of tariffs right now.
Everybody else did as well. Maybe you have more data on it. Is when they said reciprocal tariff, they kind of redefined what a tariff is for the reciprocal calculation, and they are including other whatever. I don't know what else goes in there. Maybe you know exactly what fills this in, but basically, the Trump administration is calculating an effective tariff, if you will, for each and every other country, which may not be the explicit tariff.
Correct. I mean, they call them non-tariff trade barriers. This is everything from what they call currency manipulation to things like judicial actions that restrict free and fair trade of our
Right.
products into their countries. And by the way, we know there are non-tariff trade barriers. So like it's not totally surprising. But if you and I were to do the math on these, you can kind of make those numbers whatever you want to make
Correct.
them. And so, if I had to go through this, the tariffs largely break down into, let's call it 3 or 4 big buckets, right? There's the auto tariffs. That's largely on Mexico, Canada, and Germany. And the auto tariffs were imposed at 25%. This, in fact, he had 20 members of the UAW
Worth noting.
union in the front row
Correct.
at the event. He invited, I think, the president of the UAW up on stage to make some comments. And he said, these people used to be Democrats, they're Republicans now. We're the only ones who fight for them. And by the way, this is really, he said, we won the state of Michigan because of this. This is what I campaigned on. These are the promises we made, and we're delivering on the promises. It is striking to me that just politically, this is what Democrats were running on 20 years ago. And it just shows how much the political parties have changed. So this is a big, tariff differential as it relates to autos. Then he had the reciprocal tariffs, which are the ones that I outlined here, Bill. Remember, Trump is the negotiator in chief. This is the starting point. All these tariffs go into place. We'll put these charts up on April 9th, country by country. And so we're going to hear all these ad hoc negotiations going on, some of which I'm sure, like Vietnam, he'll declare victory on even before we get to April 9th, because they've already capitulated on a bunch of tariffs.
Mm-hmm.
He's also declared that there are $6 trillion of new investments, right, that people have committed to in the United States. He mentioned NVIDIA, Apple, TSMC, SoftBank, OpenAI in his remarks. In fact, I particularly noted when he talked about SoftBank and OpenAI, he said great companies. So, for the people who are, watching the battle between OpenAI and X, that was notable. And then he said, we're going to have a minimum tariff of 10% on all countries. So even if you're not on this list, we're going to have a minimum tariff of 10% on all countries. And then, of course, China is kind of in this bucket on its own, right?
Mm-hmm.
That's going to be a huge negotiation on its own. There are a lot of things that go into that negotiation, everything from, the Panama Canal to the TikTok stuff. So set that aside, if you will, for a second. There's no way that lands, I think, at 54%. That's the headline tariffs, okay? When we do the math and we add all of these up and, say, what does this come up with, okay? The headline is we were at $77 billion last year, and we end up at about $750 billion, right? Remember, Peter Navarro, the hawk, the person who had been saying we're going to land big tariffs, he was estimating $600 billion. So this definitely landed on the larger side. But then they came out right after that, and there was a footnote about things that were exempted from the tariffs. Exemptions, which included pharmaceuticals and notably for you and I, semiconductors.
Wow.
Right? So Taiwan's got a 32% tariff, but semiconductors are exempted. And so we're going through the value of those exemptions right now. My hunch is that this is going to land right around $600 billion. But Bill, I have to ask you, here we are, you and I we're trying to make our way through this, make sense out of it. I don't think there are many CEOs we know who support this or like this. In fact, I think a lot of congressional Republicans don't like this. You've made an eloquent defense of, the benefits of free and largely fair trade. When you start hearing things like this, like, okay, this category got exemption, or this category got exempted, like, just give me your reaction. Right, as somebody who I think totally understands the benefits of free trade, when you see the Republican Party doing this, how does it make you feel?
Well, yeah, at a high level, I'm a believer in open markets, free trade, and comparative advantage, and that's been studied for a very long time. There are very solid mathematical arguments why, if you pull up the trade walls between multiple countries, that you're going to hurt the efficiency of both of them in the long run. And at least from a theoretical perspective, I'm a believer in that. I think there's another issue for the markets and for the CEOs, which has to do with both the slow pace at which they could realistically respond to this, and then the amount of ambiguity that's been out there. And so let's say what the administration wants to encourage is for you to relocate a factory that you have, or let's call it production, that you have in Thailand, and put it on the American shores. That's not a quick process. And if you start that process today, it might take 3 years, before you'd have the type of volume to be capable of bringing that back, and probably at a higher cost. I mean, one of the things that I've said over and over again, I don't think our labor is globally competitive, nor do I think it wants to be. And so even bringing it back, you're going to have a higher cost of production because we're going to have a higher cost of labor.
So kind of the core arguments that I think you've been talking about as well, Chris. I think the biggest thing you've been on for the past couple of days is this idea of why do we want to bring manufacturing jobs in the first place back to the United States?
Yeah, I mean, the lower value jobs, they don't make sense to bring them back. Some of them that are more critical to like our infrastructure, some of our shipbuilding capabilities, I could see, some plausibility in that. But the thing is, like, we're not going to say like, hey, listen, with 4% unemployment, let's bring back shoemaking back to the US because that's a strategic, asset. Now, the thing is, if you look at Vietnam, Cambodia, that's pretty much what they make. They make the lower end stuff. Like SMCI has plants in Malaysia, right? If you built those, and they have some plants here in the US, but the thing is, if you built those same like racks over here, they would cost way more. And it's a low margin business. So, it really doesn't make sense to do everything stateside. Now, the key here is that Trump went a little bit too far in this tariff thing, right? So one of the things that everyone is saying, like, and it's kind of a funny joke. Everyone's like, oh, they're putting tariffs on penguins. Bro, all some asshole did on the side was just copy and paste Wikipedia, all the countries on the planet, and basically just put it in a spreadsheet, copied this formula, and basically just click down. And that's it. Like if you use Excel, right? So you just moved it down and said, oh, you go, here's the chart. It's like, maybe don't put like Penguin Land on the fucking chart, Like that's the thing that gets me a little bit. It's like, come on, guys, it's just funny to see that.
Okay, so how are you making sense of the jobs data then? We had a big beat on non-farm payrolls. Is that good or bad right now?
I mean, look, I can only speak based on what I saw this vacation. People are spending money. People are going out. People are having dinners. People are traveling, right? People have jobs. If we didn't have jobs and we had lots of unemployment, then that's a real recession. Right now, you can see the credit spreads. Credit spreads are actually tamed right now. So the amount of recessionary, either we haven't necessarily felt the impacts of a recession yet, or there isn't a recession on the horizon just yet. So that doesn't mean that we can't get one by the end of this year, especially if like a lot of CEOs lose confidence in the current market and start like, backtracking on some of the CapEx spend that they were going to do, not hire as many people. That could definitely put us in a recession. But, there's one other thing that's very interesting that like someone, like I posted something and then someone kind of replied, and it's worth looking at really quickly. It's this thing right here. Look at all the commodity prices today. Crude oil down 8%, natural gas down 2%, gasoline down 5%. This right here is disinflation. This is what you want to have. Why? Because all of these things are inputs into the cost of manufacturing, cost of goods, like logistical transportation between cities and ports and all this other stuff. So this helps. So someone commented, "It's stagflation, you dumbass," right? Which is fine. You call me a dumbass, but
people are so nice on Twitter, dude.
Nice. But the thing is, it's not stagflation. Actually, the reason why we had stagflation is because we had oil shocks at the time. So inflation went up, and we couldn't do anything about it because the oil markets were rigged to the upside. So now, I mean, luckily there's always going to be defenders on here too. It's like, no, dummy, it can't be stagflation if price of commodities are falling.
Yeah, because in stagflation, oil would go up, right?
Exactly. Because then the thing is that there would be money chasing after those commodities. So no, it's not stagflation, right? In my opinion, this is closer to recession than a stagflationary environment, which, believe it or not, is actually preferable. A recession is bad. I know it's gonna sound bad, but recession is actually preferable to stagflation. Why? Because with a recession, the Fed can actually take some actions and lower interest rates. With stagflation, the Fed can't do that. So on one side, if you have low growth but high inflation, you got a problem. If commodity prices are coming down, inflation will come down. And if inflation comes down, the Fed can come to the rescue in case, the markets really take a nasty tumble, So
Yeah, oil prices right there, down about 7%
Yeah.
across the board. Okay, so then here's another question. We've got J Powell speaking at 11:20, I believe. If you're J Powell, what do you say to the markets right now?
Okay, so the worst thing you can say is that we're in bad shape and we're coming to the rescue, because that would crystallize a recession. That's like the fastest thing. Like, you never say out loud, like, oh yeah, we're in a bad shape and this is why we're doing it. No. It's like, oh, he needs to come out and say labor market continues to be strong. The data is pointing to disinflationary impacts. We're keeping our policy objectives in line, and that's it. Like, the worst thing you can do when the market is panicked like this is add fuel to the fire and basically now crash everything. It would be nice because short term, you might get like a blip of people saying, oh my God, look, J Powell's coming to the rescue. Like, no, but that would end up actually confirming that we're in a worse shape.
Yeah. Yeah, I think the market's going to be looking for some type of relief from J Powell, but I agree with you. They're not looking for like, hey, we're admitting that we've lost and that we need to save you guys with like an emergency rate cut or something, which ironically, okay, so I'm really curious about your thoughts on this. If tariffs are inflationary, which we can all agree they are, how the heck does the Fed justify cutting rates? Because that would just put fuel on the fire when it comes to inflation.
I mean, that's the thing. That's why you wouldn't see the Fed wanting to cut right away. The key is the market is forward looking. And so right now, as the market is coming down, it's saying that, hey, in the future, we might actually have some issues, with these tariffs.
But like, how can the market price in 2 to 3 rate cuts if these tariffs do go into effect? Because I think there's no way in hell that J Powell can cut at that point, unless we have a full on recession.
This could also be the market just calling the Trump bluff and basically saying, hey, listen, we don't believe you. We know that the economy is slowing down, but it's not like dying, and so we're in a disinflationary environment. Okay. I don't think we've got a lot of inflation ahead of us. I think disinflation is doing its thing. And I think we'll be fine, man. I think the market is overreacting right now. Energy prices, like if you look at energy prices, to me, that's a great sign. Like, let me just show everyone this thing, because I think
to your point, freaking Bitcoin, not even below 80,000 yet, right? I mean, Tesla Pouncer should be down a lot more. They're not, which is, it is kind of the market maybe calling Trump's bluff.
Yeah, I mean, you can see that this is what the Fed is actually trying to engineer right now. So we had a whole bunch of bills right now. The interest rates went super high because these are short-term interest rates, right? This is what the Fed controls, right? So you can see that they're actually coming down right now, and they're about 4.39% on our debt. The goal is to move this down here. So you want to actually issue more notes, which are like 10 years, and bonds, which are like 20 and 30 years, right? But you can't do that right now because the interest rate you would actually be pumping the interest rate higher here, right? You want to get this down to like below 2, so that this way you can issue 10-year at 3, and maybe the bonds, which is the 20 and 30-year, at 4%. And basically that'll help you manage the inflation curve, So right now we're starting to see that kind of happening, where you're seeing like, this is the total amount of debt that we have, like, and what percentage each thing is. So bills right now are $6 trillion, $6.3 trillion. Okay. And this is like live data from the Senate. Okay. So it's not like this is just me making up some numbers. And you can see here at one point, almost 60% of our debt was termed out further to like the 10-year plus. But then with COVID, we actually ended up issuing a lot more bills. And now that interest rates went up, we ended up having to pay more. Now the thing is, we have all this debt that's coming due. Now, the thing is, you want to refinance that and you want to bring this closer to 60% and actually maybe some of this to probably 20% and bring this down to like 15, which is what the historical rates have typically been around, so you can
Right.
see here, this is where the bills should be around 15%. So they're not going to try to refinance this entire 6.3 whatever. They're going to take a substantial portion of it and put it over here, but it's not going to be this entire amount. And they want to do it at a rate that's better for the economy. So if you can issue debt, longer debt for cheaper, that means that you have fewer concerns about future deficits,
If bond yields go down, do you think that gets Powell to cut rates?
No. Powell needs two things to come down. He needs PCE to come down. Okay, PCE is his guiding star. If PCE comes down, then it gives him every reason to start the process where he gets, into the zone of cutting. I mean, think about it. When PCE dropped in September, what did he do? He cut.
Yeah.
Right?
You're right.
So the key is that PCE number has to come down. Now, one of the tragedies that we have to talk about is this right here, which is the total amount of debt that we took on over the last 5 years. Look at this. We literally used to increase our debt from, about 4.37 on a CAGRing basis from 2015 to 2020. And then we went to freaking 9% CAGR, huge upward move. Our economy grew too. So it's not like it's all bad. Our GDP actually grew pretty fast, but our debt grew at an even faster pace. So this is the overhang that the Trump administration is trying to clear out, which is basically you're going to have years of trying to control this ascent. Basically, you're never going to, in my opinion, you'll never get to a point where you're going to have a move down in total debt. What you're likely to see is probably just moderating growth in the national debt, which would be good.
Because like if we're going through this experiment of trying to deal with our spending and it's resulting in this type of volatility across the entire economy, if this administration can't get it done, I don't know what administration actually solves this debt deficit crisis. Because as we're seeing in real time, it is hurting the economy to try to do that, which means maybe we just have to expect government spending is a big part of our GDP, even if it creates this massive debt.
One of the funniest things is this is such a big problem that you've got Republicans willing to raise taxes on millionaires. Like, what I mean?
Chris is talking about a headline that came out yesterday, which is that the only way we can kind of try to pay for this is a new 40% tax on millionaires, right?
Yeah, which would bring them back to what the Obama administration was anyway. So it's not like we're like screwing the entire economy by raising taxes on millionaires. It's fine. And I'm sure most millionaires, or especially people that make $1 million plus a year, they're concerned with the long-term health of this country because all of their assets are located in this country. So tell me one millionaire, billionaire that's like, yeah, you know what? I don't want to pay an extra 2-3%. And I'd rather the American dollar get collapsed or the American economy goes down and now my businesses lose hundreds, if not billions of dollars, So go ahead.
No, you're right. And it is very complicated because we do have to do something about all our debt. We have to. But the way that Trump's engaging about it, we obviously the market doesn't like it, even though he thinks it's the right strategy. It's just, I guess in the coming years, we'll find out if there actually was progress on the deficit and the current debt. But it is a very, very hard problem to deal with. And even trying to deal with it creates the type of volatility we're seeing right now.
Yeah. I mean, over time, it's something that I think will be managed. There's a lot of smart people on the both on the economy side and on the government side that can tackle this thing, especially with this administration. It's just the medicine is not very popular. The medicine actually is going to hurt a lot to take.
All right, Chris, let me open this market and then we'll get into it. Here we go, folks. 9:30, Friday, April 4th. Thank you, everybody, for being here. The stock market is now open. All right, wake your ass up. Let's see how the markets are interpreting these new Chinese tariffs. 524 on the S&P 500, down 2.21%. On the S&P, TLT is up as the 10-year goes below 4%. TLT right there, 1.79%. SMCI, Supermicro, down 4.3%. Tesla, only down 3%. I know I'm saying only, but you would think it would be getting hit a lot harder. down 3% of the day, 258. JPMorgan's down 5%. Bank of America's down 5%. SoFi is down 5%. Broadcom's down 4.3. Palantir down 4.8. Robinhood down 5.5. Micron down 4.7. Nike down 4.4. Shopify, after going down 18% yesterday, is down 6.75% today. That is a 25% decline over the past 2 days on Shopify. Meta is $4.70 away from going below 500. It hit 500.10 in the pre-markets, down about 4.92% right now. Elf Beauty, lots of exposure to China. That's down 2.8%. Nvidia opens below 100. It's up from 95 in the pre-markets, 99.97. There it goes, just above 100, but it's barely holding on to those levels. The Qs are down 20% from the highs, 440. That's down 2.34%. On the Qs, Royal Caribbean's down 5%. Carnival Cruise is down 4%. Amazon's down 6%. Hims is down 4%. Grab, which did hit below $4 in the pre-markets, right here is down 5%, $4.05 currently right now. Nubank is below $10. That's down 5%. Google is below 150. Again, it was 144 in the pre-market, so we're getting some green candles, as you can see right there, from those pre-market lows, and hopefully we don't revisit them. Bitcoin barely down 0.05%, 82.7. Block is down about 5%. Gold is down another 1%. Celsius is down 2%. Costco's down 1%. Google's down, again, 0.79. Uber's down 3.7. And then you got the S&P 500 right here down 2.3% on the day. Chris, do you think that we end green by the end of the day, or you think we continue to be down about 2%?
I don't know, man. This is policy by tweet. Remember when we started this year, I kept mentioning this, that this policy by tweet, like, way of communication is just going to bring a lot of uncertainty and a lot of volatility into the markets. And that's what we're getting right now. The good thing is, if you're a long-term investor, you're loving this. You've got probably some dry powder. You've got some income coming in. Yep. You may want to like hold off on doing certain large capital things that you wanted to do. Like right now, I was supposed to buy a house. I have money stocked up for a house right now. And I also, like I'm contemplating, should I hold off on buying the house and just buy the dip instead? So eventually, like, I'll have to talk to the wife about it and be like, listen, honey, if you were trying to build generational wealth is not going to come from the house. It's going to come from us buying the dip on Google.
I mean, but it's true though, right? These are the prices that people beg for, but they don't want to buy when we get there, right?
Yeah.
VIX right here is up 50% over the past 5 days. Here's a chart, Chris, that you're sharing right now.
So one of the things that we should look at is just keep an eye on the Dixie, right? So the US dollar index. The reason why I say that is because if you think about the market dynamics, like right now, let's say you wanted to buy something from the outside, from another country, and your dollar was worth $1, to their currency. Let's say their currency is worth $1 and your currency is worth $1.10. So if they try to basically, sell you something, right, it's going to be cheaper for them because they're earning in dollars and they're going to be able to buy that product. Now, what if their currency went down to $1? They're not going to buy as much from you because their buying power just got diminished a little bit, right?
Yeah.
So think of the tariffs in a similar way, where if the dollar comes down, it kind of negates the impact of this stuff anyway. So right now, the dollar was super strong over the last couple of years, right? But look at the dollar right now; it's on its way down right now. So you're actually seeing the Dixie come down from like 110 to now something like around 100, right? And it could actually end up going to the 70s and maybe even 80s. If the Dixie weakens that much and the currencies appreciate on the other side, all of these exporting countries, do you know what they have to do to equalize things, to basically protect their domestic markets?
Lower rates?
No, they have to buy dollars.
Oh,
they have to hold more Forex. They have to buy a lot more dollars to strengthen the dollar and bring it up. Right. So once again, if they end up buying more treasuries, what happens? Our interest rates go down. So that's also another thing that they're trying to do. And you can see how the Dixie moves in correlation. Like, can you put that one more time up there?
Yeah.
You can see how the correlation between the Dixie and the 10-year yield, how every time the 10-year, the Dixie kind of moves in a downward momentum, the 10-year moves downward as well, or the other way around, which is the 10-year comes down. So like I said, if the 10-year ends up coming down and goes to like the threes, like low threes, like let's say 3.2, 3.15, then the Dixie is going to end up going to about probably like 95-ish, which will be good, because then that means that now all of these countries are going to have to basically buy dollars and basically keep bringing the interest rates down, in which case that's beneficial for us, because now we can issue that debt at a cheaper price.
It really does seem, it really does seem like we are trying to accomplish that goal of lower rates and force the Fed's hand. And whether it's a low dollar and getting countries to buy our debt, or it's just creating volatility in the stock market to get them so afraid to touch risk on assets and buy our debt, they are buying our debt.
Yeah, I mean, I'm looking at this in the lens of 2027, like what is the economy going to look like? What's everything going to look like in 2027? Right now, you can see the Dixies, moved down since January. This is, like I said, it literally is a 10% drop on US dollar strength. So all these other currencies are actually strengthening versus us. So when you look at certain companies outside that report in dollars, they got hammered because they reported in dollars, right? So you look at an example is like Nubank, right? Nubank reports in US dollars. So on an FX basis, their earnings were impacted by that. Now it's kind of reversing, where the US dollar is weakening, which means that they earn their cash in Brazilian reals, which means that when they report in dollars, it's like, oh, look, our earnings are actually kind of strong.
Right.
Right. So
S&P 500 right here down 2.82%. Trump just responded to China like 5 minutes ago, right before we had the market open. China played it wrong. They panicked, the one thing they cannot afford to do. Chris, do you think does your gut tell you that Trump actually knows what he's doing right here and he's really deploying the art of the deal, or is he in for a rude awakening?
I think he's got an economic team that's basically guiding this, and he's basically the cheerleader. I don't think that Trump works in a vacuum. I think there's people around him that are kind of suggesting like, hey, if we do this, then that happens. And if we do that, this happens. And I think that's about it. It's I know a lot of people are like, oh, Trump doesn't, like I see the comments, Trump doesn't know shit. Trump's this, that. But there's a lot of smart people surrounding this guy. Okay. And they know how to play the markets. They know how to move plumbing around to basically get the end goal that they needed. And like I said, if you're looking at that 10-year collapsing on itself, which is the ultimate goal. Right. So,
yeah, I mean, we made this joke a while ago, but it's almost like Lutnick, Besant, and Trump sit in a room together and they have a picture of the 10-year right on the screen. And like, that's the only thing they look at. They don't look at the S&P. They don't look at the Dow Jones. They look at the 10-year. And if it comes down, then they feel happy. It's just to what extent. SoFi right here down 10%, Broadcom down 5%, S&P 500 down 2.8, almost going down 3% back-to-back days. Robinhood down 10%, Palantir down 6%. Chris, what's your take on Bitcoin holding on? Like, is this the market either saying, no, we believe Bitcoin's a hedge against inflation, or is this the market saying we don't believe these tariff rates are real, and so we're going to continue to be super risk on with Bitcoin at 82?
I mean, is 82 really that good, or is it really that bad when it comes to Bitcoin? I'm not sure. Like you look at what's gold doing. That's what I want to know.
Well, gold's outperformed. Yeah.
No, I'm saying look at gold right now. Like what's gold doing today?
Gold is down 1%.
So there you go. That should be your North Star. If we really thought we were going into recession and basically treasuries were the interest rates were going to go higher, gold would actually be on the other end of this. Gold would actually be going up. So maybe the gold market is telling us like, hey, listen, maybe maybe we've overplayed our hand in this, and that maybe there's not as much much of a recession as we think there is. I mean, look at the jobs number that came out today. It's an okay jobs number.
There's a better than okay, dude. We beat by 80,000 jobs. I mean, that's not recessionary.
Yeah. Like I said, all I can do is speak anecdotally. I did not see any spending slowdown from the U.S. consumer. Maybe Main Street hasn't been hit by all of this yet. All of this news, and maybe that's why spending is still relatively strong. I mean, from what I can see, there is a huge amount of people that own their own homes, and the people that have mortgages have them at 2%. And like 3%. So even if you were to raise interest rates really fast, which is what we did, it's not impacting their bottom lines that much,
Yeah.
So
Just to look at some of these prices, Apple is below $200, folks. S&P is down for the year. Microsoft's below 370. Meta is still holding above 500. Google at 150. Amazon 170, back to 2023 prices. Nvidia 96, well below 100. And then you got Tesla at 251. Chris, you think Tesla falls out because it hasn't revisited the March lows yet?
Well, each one of these has different exposure to the China headline, right? Like Apple has the biggest vulnerability because, like I said, they produce 90% of their products in China. And then at the same time, the Chinese market is, I think, their second largest market around the world. So they're impacted by that. Amazon is impacted because they sell a whole bunch of cheap stuff that comes over from China and basically gets posted on Amazon. So Amazon sales could end up going down because now, all these people that were drop shipping on Amazon, they might end up, not doing as well, and Amazon can't charge as many fees. So blah, that impacts them. Then, of course, you've got the other ones like Google doesn't really do that much business with China or anything. So Google is only down 1%, So I think everyone is kind of down proportional to their exposure to China right now.
Yeah. No, I think that's very fair. And obviously the Mag 7 are Apple getting hit the worst makes sense given they make all their products in China. Let's hear from Dan Ives. He was on Bloomberg this morning. Try to get some thoughts from him. The fact that Dan Ives has not necessarily gone super bearish, but he's pretty close if we don't get any changes in the tariff policy, I think has to say something about how bad things are. Because, Dan Ives, Tom Lee, these are people that tend to not get bearish even during the worst of times. And even they are acknowledging that this is a pretty bad situation that the administration is currently in. Let's pull this up right here. And then we'll keep going from there.
Yeah. Analysts, what do you do? I mean, look, 25 years covering tech and markets. It's probably the most absurd 36 hours that I've ever seen, because my view is that this is an economic Armageddon if these tariffs come through. And I think from a tech perspective, which is probably like one of the biggest assets we have in this country, it would take us back potentially a decade and it would steamroll China ahead. And that's why our whole point right here, even if you got a deal in a month or two, you're already looking at 5 to 10% earnings cuts across the board in tech just to start. And I think that's really the worry right now as a tech investor.
Apple, American icon. And for that reason, nobody believes this is going to happen. They're looking for exemptions. They report in a month at the very start of May. How do they offer any guidance at all?
Oh, I mean, we've said we don't believe Apple, or actually basically any other tech company, gives guidance, because you're essentially blindfolded playing darts, giving guidance. And it comes down to, like, if you wanted to implode Apple and you wanted to actually try to figure out the formula to actually make this company what I really view, it could take them back years. It's this tariff, because it comes down to a 54% from China. It would take 3 years and $20 billion to take even 10% of the supply chain to the US. If you want $3,500 iPhones, we should build them in New Jersey. We should build them in Texas. If you like $1,000 iPhones, you build them in China. And I think that fundamentally is really the issue here in terms of the near-term pain. Would be 5, 7, 8. It would change Apple as a company.
Which is the reason why a lot of people don't believe that this is actually going to come through. Even if there is some kind of negotiation, how much damage do you think is being done just simply through the uncertainty?
You're burning the house down, but then you still have a toaster oven and the bagels ready. The point is, like, the damage that's being done here. I mean, I've talked to so many tech executives over the last 48 hours. And they don't know. And the worry is the uncertainty, the inventory. What does this mean? Talk about, all the conversations we've had over the years, AI revolution, in my opinion, fourth industrial revolution, where we are in tech, overall markets. And this essentially, it's imploding it, self-inflicted. And I think that's really the befuddling thing for investors in terms of where we sit here and what the next steps are.
Yesterday, the Magnificent Seven lost more than $1 trillion in market valuation. That's the first time that's ever happened in one day for these stocks, down 24% from the December peak. Do you think that there is potentially, as a perennial bull in the U.S. tech sector, do you think there's actually more downside ahead simply because this uncertainty isn't going to go away?
I mean, look, this uncertainty in itself, it's already taken numbers down. And then it becomes a self-fulfilling prophecy. Now, in terms of the long term, Mag 7, our view of tech, of course, that continues to be very bullish over the long term. But right now, I mean, we are sitting on the precipice of an economic Armageddon. It doesn't matter what you say in the Beltway, in front of microphones, sit and the reality is talk to executives, see what's actually happening. And I think that right now is what tech stocks are reflecting. Investors, they're not Republican or Democrat. They're speaking in terms of what stocks are telling you. And we are in the midst of like just a massive, what I believe is an economic Armageddon if this continues.
So Dan, Apple, you've got an outperform. Tesla, you've got an outperform. Microsoft, you've got an outperform. You also cover GM, you've got an outperform. When are you going to revise these calls?
Look, it comes down to like if the tariffs stick and they continue for the weeks, months ahead, then we have to change our whole outlook.
Can you help me understand that just a little bit more?
Yeah.
So these are the dates.
Sure.
So April 5th, tomorrow, baseline tariffs, 10% kick in. April 9th, next week, the additional tariffs kick in. How long do you wait?
So let's walk through, and this is what I've been telling investors around the globe the last 48 hours. Okay, 2Q is going to be a disaster, and it's already factored.
So that's a write-off.
So that's 2Q is already like blindfolded darts what it's going to be. 3Q. So you basically have to look and be like, okay, the next 3 to 6 months, I wouldn't call them a wash, but basically the street's going to look through, okay, what do numbers look like, run rate, if these tariffs get to some sort of baseline, Q4 2026. So you basically go back to the playbook that we've used in COVID in those early days, March, June, in terms of COVID playbooks, looking out, normalize, assuming that this in some way gets negotiated. But it comes down to, if these tariffs stay, all bets off, because it changes the whole paradigm.
Chris, you think economic Armageddon is possible because of this?
I don't think so. I mean, it's a man-made problem. It can be solved by man-made issues, And I think all of these countries, everyone's eventually just going to talk to Trump, and Trump will just basically, say, look, declare victory, like we got a trade deal and we're going to remove it and blah, blah, blah. And that's it. I look at this guy as like a mobster, basically, and everyone having to come to him. And he's loving this right now because all these people are calling him and he's like, listen, I can't take this call. I'm on the green right now. Call me back next week. The economy is imploding around it. But like I said, the most important person on the planet right now is Trump, and Trump is loving it.
It is quite remarkable the lack of care they have about equity prices, just given how much they want to get these deals done. So here's the question: if we do get deals done, as Dan Ives, Tom Lee has been saying, like there's just no way we can impose these rates. I hate to say it, but that's a buy the dip, right?
Yeah. But the thing is,
like if we get a headline saying that there's no more crazy tariffs, stocks probably rebound on that.
I mean, of course, or the deals have been negotiated and X, Y, and Z, they took off tariffs on this, took off tariffs on that, So like I said, right now, the biggest problem is freaking Lutnick. Get that guy off the air, bro. He's just freaking crazy. And he's literally saying the craziest thing. GameStop is up today. What does that tell you?
Yeah, but this is what I'm like. GameStop and Bitcoin should not be up. Newsmax should not have been up 18% yesterday. And then as much as I love Tesla and Palantir, they should be getting hit way harder than an Amazon or an Apple, just given where their multiples are in a true recessionary environment. Like Amazon and Apple should get hit as well, but big multiple compression should be happening. And that's not the case, which I think, to your point, is the market calling BS on these rates.
Yeah, I mean, investors right now are, especially like retail investors, they're probably like losing their marbles. And I think some of the risk managers are probably saying, what, we need to be a little bit more risk off until we get a, clearer picture, because the thing that they can't sustain is they can't sustain losses for a prolonged period of time. Eventually they're like, look, I need to save up on dry powder and deploy it. So I think right now is not a bad time to start dipping your toes into some really good companies, especially if your outlook is not like next Tuesday. If your outlook is next Tuesday, then this is probably not the market for you. But if your outlook is like 5 years from now, you've got strong companies that can weather this tariff storm, you're going to be fine,
Do you think there's any world where Jay Powell cuts rates in May, or are you still in the camp that he's
not until PCE gets to where he needs it to be. PCE is the main focus.
Chris, we went from 26% to 40% probabilities for May today.
Yeah. Well, the market can think whatever it can think. The real data is going to be the main driver. And I'm still under the camp that we'll get like 4, maybe 5 cuts by the end of the year. Okay. Like, just because the market is uncertain right now doesn't mean that that impacts PCE. PCE is the only thing that really matters. Retail investor bought 4.7 billion stocks on Thursday, largest level over the past decade.
Wow. That's I'm going to confirm that right here. JPMorgan retail. I mean, if retail bought 5 billion worth of the dip yesterday. Yeah, that is correct. JPMorgan says retail investors bought 4.7 billion in stocks on Thursday.
And there's how much there's how much money sitting on the sidelines and money markets?
7 trillion.
So what does that tell you? That means that when rates start getting cut, all of that money is going to be flowing into equity markets, especially considering the equity risk premium now is actually on the equity side rather than being on the bond side of things.
Correct.
Because if you can only get 3% yield on a bond, like a 10-year treasury, versus let's say a 7-8% yield on a earnings yield on a like a mega cap 7, you're probably going to buy the mega cap 7 company. So
okay, so question about this. JP Morgan's predicting a 60% chance of a recession. Goldman Sachs, they all brought their probabilities up. Is that kind of heat of the moment, or is that something people should take seriously?
I think it's heat of the moment. I don't know. Maybe there is a recession. I think it'll be a mild one. Because the thing is, the good thing is that the Fed has room to cut. If the Fed didn't have room to cut, we would be in a much worse shape, because that means that now we're just going to have to deal with it. Right now, the Fed can still buy treasuries and stimulate the economy, and they could lower interest rates on the short end, meaning that people will end up dumping short end stuff and end up buying long end treasuries and basically bring interest rates down. If interest rates come down, that means that businesses can refinance at cheaper rates and basically boost up the economy. So,
right.
Yeah.
We're getting a bit of recovery on some names. Again, everything's still red, but Meta is not at 500. It's at 514. You got Shopify instead of 74. It's around 76. Robinhood from 33 to 35. I mean, like, obviously things are still pretty bad today. Apple from 197 to 199, but we are not at the peak lows that we were at about 20 minutes ago. We'll see if we revisit those. Is there anything you would be interested in buying here, Chris, or is everything on a discount, so it kind of doesn't matter? Like,
I mean, I'm pretty long on Venture Global, bro. And Venture Global is down to like $8 now. You're talking about a company that's probably going to do about $7 billion in EBITDA, trading for an $18 billion market cap. It's pretty insane. So, like I said, I've been wrong on it, but I don't mind being wrong on things, especially if I know long-term value.
This is kind of one of those markets where if you deploy capital at anything, if we get a major reversal, then like anything you buy, theoretically, you would see some better prices at it.
Yeah. The thing that we have to remember is that you're buying a business, right? And if the business it's got durable moats, it's got a captive audience, it's not in a zone where it could be disrupted by anything, if its capital structure has a ton of debt on it, and we could see future rate cuts being a possibility, these are all things that are long-term going to be beneficial for that company.
Yeah.
The one thing I'd say is if you're invested in an unprofitable company that can't maneuver around the current environment, they could end up going bankrupt because they won't survive this downturn. So you have to find those businesses that are resilient against these downturns and basically can survive and make it on the other side and actually do well on the other side. I mean, how many people were selling freaking Meta at $80 in 2022?
Yeah.
You remember that bullshit? That
Yeah.
was like peak stupidity. And I still remember being on Twitter and seeing like people saying, "Oh, Meta is dead. Meta's going to go bankrupt." I'm like, wait, what? You got a company that's generating hundreds of billions of dollars in I'm not hundreds of billions, like billions of dollars in profits. Companies like that don't go bankrupt. They just change their business model around. They finagle their capital structure a little, and boom, the stock skyrockets. And I think the same thing's going to happen with Google. Same thing's going to happen with a lot of these companies. Like, they're going to see this and say, look, we've got some short-term headwinds, but our stock price is 60% lower than what it was before. Screw that nonsense. Let me just freaking buy some shares back, boost that up, take value for shareholders. And like, that's one of the things that we should all remember, that look at all of these companies as businesses. Like, would you want to buy this business? And look at the returns that you're going to get. Extreme fear.
Absolutely extreme. Let's get an update right here on China, and then we'll keep going from there.
Yeah.
American import is around 50%. And this tariff is going to go into effect on April 10th. Now, to target farmers, which has been a key base for President Trump, China's suspended imports of 5 agricultural companies. So the reason they gave is because these companies ostensibly didn't meet certain health and safety inspections. So those companies that are targeted to export sorghum, chicken, as well as chicken bone meal. China expanded its export controls for certain rare earth minerals. What's interesting here is that not only are these ones that are used in electronics, but also for a lot of medical devices, such as MRIs. So these are, that's going to go into place. It also is targeting medical gear, CT tubes in an anti-dumping investigation. Finally, Beijing has placed restrictions on 27 companies, mainly in the defense industry. Those ones are largely symbolic. We've seen these companies on these blacklists, the unreliable entities list or an export control list before, mainly because of their work by supporting Taiwan, of course, the island that China claims as its own. Guys?
Eunice, we talked about DuPont now in the midst of this alleged anti-monopoly probe. Have they established any criteria of which American companies might be at risk?
Well, at this point, it's really anyone's guess, and everybody's on the table at this point. I mean, I'm really surprised at this level of escalation by the Chinese, especially with the tariffs, because in the past 2 rounds, they were seen as relatively limited. This time it hits all different imports. And I think what's also interesting is that for these types of items, it doesn't just depend on whether or not Chinese people like to buy American products. It also depends on whether or not Chinese state companies are going to be told to stop buying those items or not. I mean, just in the past month, from the previous tariffs, we saw a huge disruption in the number of and the types of items that were brought into here from the U.S. The large cars, for example, those ones saw a double-digit drop. Let me just take a quick look. Down nearly 70%. The purchases of crude oil, LNG also dropped more than 40%. So that was just from the past round of tariffs.
This is going to be very interesting in terms of how it plays out. The big thing for me around the China stuff is, will these 34% tariffs actually go into effect? And I think they picked April 10th for a reason. April 9th is when a lot of the other tariff rates that Trump talked about on April 2nd go into effect. So we got a week for the market to kind of see how this plays out. But after April 10th, if we impose tariffs against China and they impose the 34% reciprocal against us, I mean, I don't know how the market officially reacts to a full-on trade war at that point.
I mean, it's the Chinese. They're our greatest adversary now. So I think of this as, us just being us against the Chinese. We want to, the part that gets me a little bit riled up is, why would you want to move your supply chains to Vietnam and then punish Vietnam?
Yeah.
Don't do that. Because then that's dumb. And then you told all your supply chains to move to Cambodia. You did that. So right now, I think people are, especially a lot of companies, are just pissed off. Imagine being Nike and saying, you know what, China is a problem, we're going to put tariffs on them. And then you move all your production to Vietnam. And then you get Vietnam gets tariffed too. And now you're dealing with it. It's so I think eventually the Trump administration is probably going to put a lot of carve outs. Maybe they'll do a grand deal with China and that'll just get the markets up again. The key here is the 10-year. We just need that 10-year to keep going down. And I think eventually once we get to the threes and then Jerome Powell comes off and says, hey, like PCE is down to what it needs to be, everyone will be happy again. Like for me, I look at shelter as the key thing for PCE to come down. Once shelter comes down enough, we'll be fine.
By the way, GameStop is freaking up 4%. Bitcoin's up 1%. I mean, it is one of the weirdest sell-offs I've seen in terms of risk-on assets going green in the midst of Apple being down 5%. But I guess this is the world we're living in right now.
Yeah, and just to show people what I mean by the PCE thing, look, this is what the Fed is using, okay? They're using PCE to determine when they're going to cut. So you can see here in March of 2024, PCE was 3.3, way above what their 2% target is, right? It came down to 2.5, and the Fed was like, okay, let's start cutting. And they started to reaccelerate and went back to threes again. The key here is we really need this to go down. I think the Trump administration is getting kind of frustrated right now with PCE staying relatively high. So they're like, all right, you don't want to go down on your own? I got you.
Seems like that's how it's playing out. Chris, your gut feeling, I'm going to ask the chat about this as well. Do you think December 31st, 2025, we're sitting back laughing on today, just like we laughed on about August 5th at the end of 2024? Or do you think we have tears coming out and maybe they're not out of laughter, they're out of a different feeling on December 31st?
I mean, if you look at history tells you that this is like max pain mode. Like you're looking at the fear and greed index, that shit's at single digits at like the 6, 5. That's like max fear, right? This is the time where people should be buying. I know a lot of people are probably scared. They're crying. They're like, oh my God, what's going on? This is what we've been waiting for,
Can you speak to also, this is kind of the price you have to pay to be an investor, right? Unless you're perfect at timing the top and the bottom, you're going to end up in these situations. Everyone is. I mean, I would imagine the biggest hedge fund managers in the world are down hundreds of millions of dollars right now. And it's kind of just what you have to deal with if you're going to be investing.
Yeah, man. This is part of the investing journey that everyone's going to have to go through. I've been there. Okay. You think COVID was like, oh my God, this is the greatest market in the world? Like, no, COVID, everyone's portfolio got wrecked during COVID and then it recovered. Everyone's portfolio got wrecked in 2008. And that was way worse than what we are seeing today. The tech bubble was really bad too. Like these things come around. Okay. Like people need to get over it. And the thing is, we are nowhere near each of those things. Like the tech bubble was just really, really bad. The tech bubble was literally PEs of tech companies that were pre-revenue trading at like not even PEs, just the companies were trading with no revenue at such high amounts, right? Then you had the 2008, which is basically fraud in the entire economy.
Yeah. And
then you had COVID, which is a complete shutdown of governments and businesses. I mean, are we anywhere close to that? No, of course not. So
yeah, Dexter has a great comment right here. And then if you get a multi-bagger in a couple of years, it's not luck. It's because you deployed capital when no one was willing to deploy capital, while acknowledging that your capital could continue to deteriorate at any time when you deploy it.
It's not fun. It's really not fun looking at your portfolio and looking at it and just being like, oh my God, I'm down hundreds of thousands of dollars, But it also means that there's opportunities out there too. So if you've got the capital to deploy, and you're seeing companies that have strong businesses, remember, treat everything like a business. When Mr. Market is drunk and here to give you discounts, you're not supposed to turn him away. You're supposed to say, come right in, Mr. Market, give me that discount. So the question is, what companies actually deserve a discount and which ones don't deserve a discount and deserve to get put down significantly?
MicroStrategy is green. I mean, it's very interesting how this is playing out. One argument, I think, for why tariffs theoretically could be bullish on Bitcoin, it's a pretty simple argument, but if tariffs create the bond yields to go down, the 10-year comes down because people are afraid of stocks. That means Jay Powell is going to eventually cut rates towards the end of the year if we continue to get inflation to come down, and that's good for liquidity, which is good for Bitcoin. Now, the problem is if the NASDAQ falls 10% at the same time, I think the risk-on appetite also deteriorates, which means even though Bitcoin's a global liquidity asset, if there's a lot of people that are selling off tech stocks, it's hard to imagine they're going to buy Bitcoin, but who knows? Maybe that ends up playing out. But Bitcoin right here is green, along with MicroStrategy and some of these crypto-related stocks.
And dude, one last thing. This is not the type of market you want to sell cash covered puts into.
No, not at all. No.
Even if you think that, hey, look, I'm getting a great deal on this and I don't mind owning it, dude, especially if you end up going in margin. I don't know if someone in the chat's like, have you checked up on TJ? And I'm like, listen, that's one of the things that I always caution people about. And that's what I was getting scared about, which is buying companies on margin, thinking that, hey, I don't mind owning this company at this price. But then the dip just keeps dipping even more and more and more. And now you're going to get margin called. You're going to have to dump positions that actually you want to buy, So luckily for me, I'm not leveraged right now. So I don't care. Things will recover,
No, I agree. And if you're on leverage right now, it's tough. Selling puts on margin in this environment is very tough. However, selling puts in general, if you have the cash and you're not borrowing the cash, like if you sell a Robinhood $30 put, I mean, if you're into Robinhood, I don't think you would be opposed to buying it at 30. So getting paid to wait for it to die out even more, I think is a smart strategy, especially because these are the days where the premiums are up. But if you're borrowing that $3,000, which is $30.
Yeah, if you're in cash, if you're doing it via cash, then yeah. But if you're doing it via margin, then don't
Yeah, if you're borrowing money to collateralize the cash secured put, that's when obviously it can get bad.
Yeah.
Okay, this was another thing I wanted to ask you about, which is right here. So, Europe. Okay, so Europe's also falling right now. It's not like Europe's immune to this. European defense contractors did great this year. We saw foreign money leave the United States, go to Europe. Do you think Europe is insulated from this, or is a lot of the boom that they had also potentially going to get killed if tariffs get in place globally?
No, they're stimulating. They're willing to spend more. Like if you look at Germany is doing more deficit spending. So I think the Europeans, they'll be fine if they keep like actually spending money on their economy and stuff. And the thing is, people are going to be looking to go over there and spend money over there. Like what I mean is, like, investors are going to be willing to invest in companies over there that are low PE companies that are good businesses, especially in a stimulatory environment.
So you think Europe actually is a reasonable place for capital to be allocated to right now?
I mean, depends on which sectors you're talking about. Like Europe traditionally Europe has a lot of structural things that I'm not a fan of. They have high taxes. Like the businesses are heavily regulated. So for them to compete internationally ends up being really difficult. And, the value that gets transferred to shareholders is a lot more limited. Damn, BG is down to 7.68. Shoot.
Palantir is down 8%. Robinhood's down 12%. Amazon's down 3%. Nubank's down 7%. Tesla's below 250. Grab's got to be below $4. Grab's at $3.99.
Yeah.
Clorox is green.
Defensive. People are just being defensive.
This is a stock that Steve hates right now, but yeah, people are being defensive. Baba's down 10% as well. So the Chinese stocks aren't loving this announcement either.
Yeah. Yeah.
FXI down 6%. BlackBerry below $3. CoreWeave still above its IPO price, but down 8%. Chris, you think this hurts the M&A IPO markets if this market continues to be how it is?
Not sure. I'm not sure. Like CEO confidence has to come back. They're actually going to get a decent valuation. Like Venture Global just went public and they got absolutely demolished. Yeah. So, you really have to come out and be like in a really good place and show the markets that you're not there. But I personally would hold off on coming out and being public right now. You're trying to maximize the price on your shares, not try to sell into a money hole right now, And I think the thing is, we're also very heavily indexed. So a lot of index investing is just going to drive things down. Like it's basically going to cause selling of things that may not necessarily need to be sold as much based on rebalancing.
This is ugly, guys. This is ugly. I mean, it's one of those days where It is really disgusting. And obviously, I think the reason it's this ugly is because of the uncertainty. Like the market can handle a lot of stuff. They cannot handle not knowing what's going to happen. And right now, no one knows what's going to happen with tariffs.
Yeah. It's unfortunate, but once again, this literally is the time millionaires and billionaires are made. You know, you look at Brad Gerstner, right? You know how Brad Gerstner became a millionaire or a billion? Well, I don't know if he's a billionaire.
He was in college. He was trading stocks, and he went all in on like one stock when it fell or something. Am I wrong?
He borrowed money and started, from his friends and family and bought the dip in 2008.
Ah, wow.
Do you know if what happened? Like how much you would be up right now if you bought the dip in 2008? It's crazy. And it's not like you had to pick a good company or a solid company. You could have took a dart, put all the S&P 500 constituents in the large cap, just threw the dart in there, and 9 out of 10 chances you probably would have like 5x your money.
Yeah, you are right. By the way, we just got a headline: Cambodia is going to be lowering their tariffs on some United States imports to 5% from 35%.
What is this? Cambodia, I don't even think had 35%. Bro, you're harassing the Cambodians?
What's funny about this is like, yes, it's good, but it's like, it's Cambodia. It doesn't matter that much. Like,
I mean, the trade deficit, I don't know what our trade deficit with Cambodia is.
It's like, wow, this is huge. Cambodia lowered they started capitulating. It's like, how much trade do we do with Cambodia? It's actually gonna find that out.
Hold on. I got something to show that's pretty funny about Cambodia. 1 second.
It can't have any copyright music or anything.
It's not. It's not. Hold on. There you go.
Yo.
All right.
All right. The only way I open the studio up now, y'all got to walk uptown to the Bronx and get breast milk from a Cambodian immigrant. I only drink the finest breast milks. Go out there and milk Cambodia.
Okay, that's funny. That's well, maybe that's what we get from Cambodia. Google is saying right here we have about 13 billion of goods that we do with Cambodia. Which
13 billion, right? And the U.S. exports 320. What's 13 billion and multiply that like a 30%? What was the tariff on them?
Let me check the tariff on Cambodia. Let's see. It's some ridiculous. I think it's 40%.
You seriously we're gonna tariff Cambodia, dude? Like it's just like which industry does Cambodia have that we really want back in the country? Please tell me. Like, is there a semiconductor plant that they built in Cambodia that I don't know about that's like crucial to national security?
Rocket Lab right here below 16. But see, this is the problem. It's like if the Trump administration comes out and says, hey, well, we got Cambodia to capitulate. I mean, the entire world is laughing at how that's playing out, and the fact that he's even excited to say that Cambodia is a meaningful concession here. Let's hear from Nick T from the Wall Street Journal, get his thoughts, and then we'll keep going from there.
If there's any good news, it's that you now know, what the cards are on the table, and whatever uncertainty was there before, obviously it hasn't gone away, but you now kind of know what you're dealing with. I think the problem is that nobody likes what they're dealing with here. These are larger tariffs than what most people expected. These are larger than what Trump himself had run on during the campaign. You recall he had run on a 10% across the board tariff and 60% on China. It seemed like China, as was the case in the first term, was going to be the focus of trade policy changes in the second term. And so these tariffs announced yesterday, Madison, were just much larger than what people, even at the more pessimistic end of things, had been expecting.
Nick, where is the voice of the business community in all of this? I mean, I remember during past presidential terms, if there was something that the business community didn't like, they were quite vocal about it, or the Chamber of Commerce was quite vocal about it. Are you surprised that we're seeing it show up negatively in the survey data, but we don't hear a louder voice from the business community?
Well, I think you look at some of the other things the administration is doing, targeting universities that have taken positions that maybe the administration doesn't like, going after some of these big law firms. And so you may see a culture of fear. Nobody wants to be the first to file the lawsuit challenging the constitutionality of these tariffs. Nobody wants to be the one to stick their head out and have it get cut off. There could be some of that here. I think there's also been just let's see what this is.
I also think the reason why business leaders are not speaking up is because they all kissed the ring. What is Zuckerberg supposed to say? I mean, Elon Musk, past 48 hours, have we heard a single word about tariffs? Elon talks about everything. The fact that Elon's been quiet, I don't know, dude. It feels like a lot of these business leaders don't want to say anything because they're afraid they'll piss off Trump.
Pretty much. Also, I'm telling you, we really need to dissect Lutnick, man, and get his thoughts on this. Eventually, though, I think Trump is going to capitulate. I already see Trump capitulating on certain things, trying to get the market back up again. Like you saw his thing yesterday before he left. He was like, "Oh, we're going to have the stock market boom."
Yeah.
Even he knows that the stock market may not be a perfect representation of Main Street, but a lot of people have their retirements. A lot of pension funds have their retirements in the market. So, no one is exactly like happy to see the market come down, Like it's just one of those things. It's a visceral feeling to see you lose your net worth in the market right now. And the thing is, when election time comes, people are going to remember that in the voting booth, So no one's going to be like, "Oh yeah, you did everything right for the long term for the country." Like no one remembers that. Everyone's going to remember my portfolio used to be X and now it's Y. So,
but it goes into a deeper question here, which I think we've talked about before. But if the portfolios that all of us manage were only up in 2024 because of insane amounts of government spending, and we're stopping that, did they really deserve to be up as much as they were?
I mean, it depends on the business, right? The key is the private sector, in my opinion, after COVID kind of took a step back. Like banks and traditional banks that kind of like got sidelined. And especially after 2022 and 2023, they really got put on the back burner with a lot of regulatory changes. So the government had to kind of step up and spend more money. Now the government is stepping back. And that's why Scott Bassett is actually saying, like, look, we need to get the private markets, the capital markets, to start putting money into the system again,
right?
Start lending again. So I think if that happens, then this is a wash. Right now, I'd say to people, don't look at your portfolios, just chill, relax. Everything will be fine. We've been here before, all right, and we'll recover. If you have dry powder, keep some dry powder and basically look at the companies you like, buy some shares. Definitely wouldn't do any options on it because you don't know when this thing is going to eventually recover. Especially short dated options, would not touch that.
Wow. S&P, Chris, almost 4%. Holy crap.
Yeah. Well,
3.4. No, I agree with you. And also, look, I agree with this as well. Even if government spending was a big cause for the stock market going up in 2024, I think the extent of the damage we're feeling in 2025 is not just because we're cutting spending, because we haven't actually really cut spending yet, but it's the way the tariffs are being implemented, right? Because we saw the market rally on a 10% flat import tariff. Markets were like, all right, cool, we can deal with that. They probably could have dealt with even 20%. But this whack-a-mole type of random rate for every single country, I think that's really what's creating the pain we're seeing right
now. It's funny. Someone said we should look at Cantor Fitzgerald's short list on what they've been shorting and see like if there's some kind of manipulation here,
Dude, if Lutnick is making money off this, I mean,
I don't think so. I think it'd be too obvious.
You know what the sad thing is, though? The sad thing is the fact that thought even comes in your mind is because of the nonsense that we've seen from the Trump administration with this crypto coins and the obvious risk, right? So the fact that we're even thinking, hey, is Lutnick potentially manipulating stuff? It's because of this subconscious belief that the Trump administration has already grifted in their first 100 days of being in office with the Trump meme coin and DJT as a stock itself. I mean, it's insanity. Absolutely insanity.
Yeah. Yeah. Damn, man. I'm looking at this market. It just keeps going down and down. I was actually thinking about doing like a daily evening, like just a 30-minute like round, like what is it called? Like what is it called? Just an episode where basically we just go through all the stuff that happened in the markets, where valuations are, based on industry and historical averages, and then go from there. Like if you look at on a per PE basis on a lot of the companies that we're seeing here, they're starting to hit really good value territory.
Well, we should do it. Every Saturday night, we should do it. That would actually be fun.
Yeah.
Right.
Yeah. Especially if you, like I said, this is where you would dissect each company individually. You dissect the business model. I think that's one of those things that needs to happen right now. Not necessarily, hey, let's look at the stock price and do tech. Like this is the one gripe I have with guys like Jason and these technical analysts. Go ahead, tell me that things are going to go in one direction based on some random technical.
Yeah, I mean, and Jason also admits fundamentals always matter more than technicals, and fundamentals right now are bad.
Yeah, so it always comes down to fundamentals tell you what to buy, and technicals tell you when to buy. So when things are technically oversold, that's when you want to buy, and fundamentals teach you like, hey, this is a good company, this is not a good company, this has a good capital structure, they've got a moat, and basically you go from there.
Yeah, it's funny because in a bear market, technicals might not matter as much, but that's when macro matters a decent chunk, right? Because then you're trying to figure out what is the story to this puzzle right here.
And the company's fundamentals too, right? Like there are companies. You remember when you started talking about Robinhood, and you really got deep diving into Robinhood, and you were just like, wait a second, they've got what 50% of their market cap in cash? How's that freaking possible?
It was 70% at the time.
70% in cash. That's how stupid the market is sometimes. I'm telling you, that's why I look at Venture Global and I'm like, how does this make any sense? This company's like projected to do about 7 billion in EBITDA, and based on the current market cap, the market cap is what, like 18 billion? That means that a little bit less than half their EBITDA is going to be generated. And this is 1 year of EBITDA. Okay, 1 year. I mean, they've got a lot of debt, don't get me wrong, and they're going to have to tackle the debt, but most of their debt is actually hedged, so they don't have an issue with that. And they already said on their earnings call that they're contemplating doing share buybacks. Last couple of weeks ago, insiders were buying shares in the open market.
And if rates come down, they can refinance a lot of that debt.
Right, exactly. So it's like it's crazy to see like that, when companies drop by that much.
But the Googles being at 149, the Amazons at 170, you would say that's not a function of their fundamentals at all. That's purely a function of macro.
It's fear. It's fear, man. And I don't know. This is what I don't get though. People will buy Clorox, but they won't buy Google. And it's like Clorox, yeah, it's a safety stock if you think about it, but Google is the actual real value stock because they generate huge amounts of cash. But I don't know. People are like, hey, I just need to stay out of the tech sector, and people just invest based on that. So.
All right, we got Jay Powell in about an hour. Let's get a little bit more of an update on these tariffs, and we'll hear from Jay Powell in a bit.
Yeah.
Big time. I mean, oil now is at the lowest since 2021. That's helpful for the economy. It's helpful at the gas pump. Interest rates have fallen sharply. We're seeing the 10-year yield now below 4%. We're at the lows of the year. And the U.S. dollar, as Rick was just saying, it's significantly weaker. Is it happening for the wrong reasons? Yes. Yeah. It's because there's a big markdown in growth anticipation for the U.S. But this will help cushion.
Yeah, they're offsets.
What's coming? They are offsets.
To some degree, yeah.
I mean, they are like lower interest rates, lower mortgage rates, right? Lower borrowing costs, cheaper oil prices, weaker dollar will help our exports, even though we're going to have a lot of trade barriers.
Just, if you need to get mortgage rates down like into the 5.5 or whatever range where a lot of the existing mortgages are to really restart the housing market, I guess the question is, what do we have to sustain in terms of the economic outlook to get there? And so, yeah, I totally agree with what you're saying. And look, I said yesterday that ultimately we can also come back to this is mostly a domestic kind of focused, service-oriented economy that's not make or break based on trade. I think that what the market's reacting to is this sort of belated overreaction type dynamic, which happens in markets, which is we were hoping that these firewalls would hold. We were hoping it would be a more moderate response as opposed to the maximum tax on global trade that's going to penalize the most efficient production across the globe. So I think that that's, obviously the market is now figuring out, have we started to quickly reprice to a negative enough scenario that we can build from there and clean out a lot of the complacent positioning that obviously was in place.
How can we say that when we haven't even started with Q1 earnings or corporate commentary?
Look, the market tries to front run everything, and the market tries to discount what's coming. But I do think that's a challenge in terms of, to the degree we can get some kind of short-term tactical crescendo of selling, whether it was this morning or coming up. Look, I think the thing that worries me most is what it means in terms of all the financial stress indicators that have flared this morning. So I mentioned
VIX above 40.
Yeah, the VIX popping above 40, and then everything along that same chain moves, right? Credit default swaps, high yield bond spreads. You see, various volatility measures throughout the market, and all that really means is that people are in intense risk-off mode, and they're willing to contemplate the negative tail scenarios. It doesn't mean it's going to be self-fulfilling.
All right, I'm not done. I have more potential silver linings here. One big one is that the Fed has a lot of room to cut. And it's important because the Fed has been restrictive in its own words and very tight. And Chair Powell is going to be speaking this afternoon. We'll get his reaction to jobs, his reaction to tariffs. There's a chart out there. If you look at what's happened with the 2-year yield, which is the market's best way of anticipating what the policy rate should be versus the actual policy rate, the Fed funds in orange. Thank you, Ben Amons, for this from FedWatch. The market is pushing the Fed to lower interest rates and expecting more interest rate cuts as a result of all of these tariffs. In other words, yes, the Fed has a dual mandate, right? It has to fight high inflation and it has to fight weak economic growth. The market is telling you that the growth side of it is going to be more important and the Fed is too restrictive than the inflation. Now, the Fed's going to be cautious because it doesn't want to make the same mistake that it made last time around, thinking that inflation was transitory and being late. However, there's room to cut. And I don't think if Fed Chair Powell continues in his stance of we're not in a hurry, I don't think that's going to be good enough today. I think he needs to talk a little bit about the downside risks of the economy, which would signal that they will cut if they need to. It's not going to offset a trade war, but it'll help.
For a long time, you were critical of all cuts. You didn't like the 50, and now you're in cutting mode. The other is that you also argued that totally tariffs are something the Fed shouldn't really have to look through. And now are they going to be responding to a tariff-driven, supply-driven demand story?
No, I think they should look through tariffs on the inflation side and worry more about growth, which is what I've always argued. Yeah. And now the growth outlook has deteriorated substantially. So it is time for them to start thinking about cutting. They do have to totally.
Wait a second. Can you pause that? She just said the growth outlook has gone down. Where?
I guess she's saying the perception is growth will slow down because of tariffs. But we haven't had any hard data yet that that's happening.
Right. So how is she saying, let's start, this is what I mean. This is panic. She's panicking. Why is she panicking?
Well, I think her argument is, okay, Q1 guidance, if that's horrible and we get estimates of growth from 10% to 5% across the board, that's where you think of cutting. But you're right. I mean, we don't have those yet. So Powell can't react to that if it's not real.
Yeah. I mean, this is what I mean. When CNBC starts panicking like this, it's usually a good sign that we're at a bottom, She just literally said, oh, look, there's a growth scare. Where did you see any company come out and say, hey, listen, we're challenged by the consumer not spending as much money? Hasn't even happened yet. We're 48 hours into this bullshit?
It's fair. We have not have any confirmed data. We don't even know if these tariffs are fully going into effect yet. I mean, we still have 7 days. So, I mean, you have a point right there. It's just a question of the perception of it now.
Yeah, let her finish.
Sure. That inflation is not a big problem. And that, that's an uncertainty because tariffs raise prices. However, if you look at what the market's telling you, inflation expectations go out 5 years.
Oh, yeah.
They're not
I know, but the
up.
1 year break even is it's telling you it's going to be a
short-term issue, but not a long-term issue.
Yeah, I agree with that, to be honest. I mean, look, we hiked when inflation was short of target, back in 2015. Like, it's not as if it's some kind of a circuit breaker on the potential for. I think the bad scenario for the market is if the Fed is going to be backed into that position of waiting for like the financial plumbing to clog up, and all of a sudden it's about a systemic thing that happens, which gives them cover to act regardless of what the inflation outlook is. And nobody wants that. I'm not saying it's happening, but I think they're going to be slow in saying downside risks to growth are such that we're going to front run the data and cut.
Yeah, the problem is they might be too late then when they do cut.
That's the 2-year note suggesting.
And that's what it's telling you.
Yeah.
We have a great chart of the short-term and longer-term inflation expectations, 2-year and 5-year. So you're right, Carl, 2-year, they're getting nervous about inflation, and that would make sense after tariffs. But long-term, 5-year swap, it's going down. And that suggests that there's less worry about persistent inflation
Right,
and
so
more
they're going to
about
be
growth.
backed into a transitory framework.
Well, no, or it means over the 5-year...
That they're going to have to cut because growth is deteriorating so much.
Over 5 years, there's going to be a recession, is what the market is
exactly.
saying. And that's going to just
Pressure
completely
inflation
pull
lower.
inflation out of the system.
I think that's the key. And so I am listening for that. And then there's the other thing, which is Republicans aren't exactly on board with this. I mean, let's look to Congress. I hesitate to say, let's be optimistic looking to Congress, but I think this is something that will make Congress aware that it needs to be in the building, right? And while this is in the power of the executive branch right now,
The fact that they have a bear, yeah, this is fear.
did take note of a lot of comments from Senate Republicans that were anti what the president is doing. Senator Ted Cruz, tariffs are a tax on consumers. I'm not a fan of jacking up tariffs on American consumers. There it is. Senator Rand Paul on the Hill. I think it's just economically a fallacy to think it'll help the country.
Wow. Cruz and Rand Paul not supporting Trump here, going the opposite direction.
They're the mavericks of the party, though. Like they're actually not. They'll say what they actually think. There's a few Republicans that actually will do that. Most of them will basically toe the party line. These guys are the ones that Thomas Mazie's like that too. Where they'll actually say how it is.
Yeah.
Jeez, man. Damn,
Palantir down 10.5, Hood down 15, Nvidia down 7.
I wonder if Steve covered his position yet on Palantir. Because I know he was pissed off when he saw those covered calls.
No. He still has those covered calls open.
He does?
Yeah, so that's good for him because the price is getting a lot better now.
Yeah.
I think he has them at 45. That's his strike. So
yeah,
he might get what he wants in terms of this getting cheaper for him. Bitcoin right here still barely red. Newsmax is up 5%. GameStop's up 3. TLT, that one makes sense. Where's the 10-year right now? The 10-year is 3.90. Very close, going below 3.9. But see, here's the thing, Chris. If the 10-year goes down, won't a bunch of green days in the stock market get it to go back up, which is the opposite of what Trump wants?
Not if we get to the point where the Fed ends up actually coming out and saying, you know what, we're actually going to start cutting, because of X, Y, and Z.
Right.
So right now, I think the anticipation is and we'll see what Powell says. And I'm sure that he's going to make a comment like the markets are maybe in a turmoil or whatever. But he's like, no, the Main Street continues to be strong. So we'll just leave it at that. Jeez, man. This is
ugly, bro. This is bad. It makes you believe. Obviously, these companies are not trading at prices where their earnings or their forward earnings would dictate at any reasonable multiples that we're seeing. But it is a direct response to the fact that the market does not want to bet that they think this Trump tariff policy will actually be effective. And as a result, they're just saying we're going to leave. We're going to leave until you tell us what's actually happening.
Can you believe freaking Robinhood got cut in half over literally less than 2 months?
Yeah. Well, Nvidia 140 to 95, Tesla 487 to 210. I mean, Warren Buffett 300 billion in cash.
This is how this guy makes his money, bro. He literally just waits until the market itself. And that's what I think that's the key lesson to take away from all of this, which is there is no patient investor like Buffett. Not saying that Buffett doesn't make mistakes. He's patient on the long side, but he's even more patient on the short side. So if you look at 2008, he was sitting on a lot of cash, and all of these guys came to Papa Buffett, and he bought things at like record lows and just enjoyed that return for the next 10 years.
People don't know he sold $35 billion worth of puts on the S&P in 2008. He collected $7 billion in premiums. It was the biggest put sell ever, and he just went long America in 2008.
Yeah,
and
I think structurally long term, you have to be long America. America is where we have the greatest capital markets. We've got low energy. We've got a dynamic population. Innovative tech scene. I don't think any America's going anywhere. I think some people that are calling for like America's going to eventually collapse and blah blah blah. All that stuff is BS. Don't bet against America.
There's okay, hold on. Let me do a couple super chats and then we'll keep going. Jerry Coleman, thank you for the $5. Appreciate it. Papa K, thank you for the $10. Live frugally now to be wealthy forever. 1000%. I mean, this is the time where if you have any excess capital, deploying it really helps. Chris, we didn't talk about cruise lines. Obviously, they're getting demolished, but Carnival Cruise still said this would be their best year ever. Do you think they revised guidance, or do you think they deserve to be down 15%?
No, I think they're fine, man. I think they're going to do okay. All their seasonal booking is like a year ahead, and they're literally filling rooms for 2026 right now. Fear and Greed is at 4 now. Jesus. What was it at COVID? Let me see. Like long term.
I think it was 1 at COVID. But at this point, it might as well go below 1. I mean, this is.
Let's see. I have the chart that gives.
Oh, there's the 10-year 3.8. There you go.
Jesus, bro. We literally look at this. This is the chart for Fear and Greed. So Fear and Greed, this is where we've basically been. This was the 4, and this was May of 22. And we're currently at 4. So we're literally at May of 22. And then you can see that was kind of like a somewhat of a bottom, because the S&P kind of went up and then it kind of went back down again, and then kind of just did this recovery maneuver,
Enrico says, why was the 10-year down in September 2024? It's because inflation was 2.4%. So, and then, again, the problem is people thought Trump was going to win. They took at least as companies took the tariff seriously, and they started importing a crap ton in Q4. And that got inflation to an extent to go higher. I mean, if anyone's wondering why is inflation still an issue, even though we thought it was resolved in September, one of the theories I have is that companies imported a lot of goods, and that ran up supply chains and bottlenecks on the supply chains, which created more inflation. And that's where we're back to basically 3% right now.
Yeah, and what's funny is a lot of that was rhetoric from the Trump administration.
That's all it was, rhetoric.
So.
But now the rhetoric is becoming true to an extent, right? Like those companies, if you're Walmart and you ordered 1 million Samsung TVs before the tariffs went in place, you're happy. But obviously that created more inflation.
Yeah. I mean, how are some of the other stocks that are insulated against this doing? How's American Tower, Crown Castle? How are they doing? Let's see. AMT.
Okay, so AMT is up.
Fucking 230. Jesus. CCI.
That is barely red.
Okay, and then SBA is another.
Verizon's only down 2%. SBA is down 1% roundabout.
Yeah.
It's better than NVIDIA, Robin, or Rocket Lab right now.
Yeah. It just goes to show some business models are a little bit more insulated against all this tariff stuff. So they're going to do okay. What are some of the high flyers today? And damn, Palantir's down to 73.95.
Okay, so we've been super serious for the past 2 hours. Let's look at a funny video. This is a hedge fund manager who is apologizing to his clients about losing $150 million.
I am so sorry that I was unable to manage the rogue wave that hit us this week. I wish I could name you all by person right now, all 290 clients of ours. You were my family, and I'm sorry that this rogue wave capsized our boat. In the coming days and the coming weeks, our office doors will be open, our phones will be answered, and any questions that you might have, my staff will do their best to answer questions you might have and somehow help. I want to thank you all for becoming part of our family. I wish you all the best, because every morning when I woke up and I checked the markets, and my wonderful wife made us dinner, I took my laptop and sat it next to me while I was sipping a glass of wine, because I want to check on the markets and make sure that they were okay. I am so sorry for not managing our ship and keeping her afloat. I bid you great luck and good health, and please feel free to call our office.
There's an old video. It's not about what's happening right now, but it's hilarious because, dude, you've got to have a lot of geniuses who started a hedge fund at the top in 2024 or recently, and they're dealing with a corrective. Right? This is the thing about being a hedge fund and managing money. It's a lot easier when things are going up. It's tougher when shit hits the fan.
Dude, you know how many people end up like committing suicide and stuff like that when things like this happen? Some people really like are staking their life savings in this market. So I don't know. Whenever I see people like crying over stuff like this, part of me is like, grow up, be a man. But the other part is like, damn, bro, I've saw my own dad lose his shirt in the stock market in 2000.
Why don't you tell that story? Because people that are new to the channel don't know about the story. It's why don't you go and tell it? What happened to your dad?
Yeah, well, in 1999, one of like my dad's friends came over to visit and stuff, and basically told my dad, like, look, I made all this money in the stock market, blah blah blah. It's simple. You just, I just buy this and it goes up and blah blah blah. And so my dad, he's like, oh well, I'll just take a little bit of money and I'll just put it in the market and see what happens. And then he got some really early wins. And because of those early wins, he started dumping more and more and more. And to him, it was like, oh my God, the stock market's like the avenue to change my life, And what he didn't realize is that he was buying into a bubble.
Yeah.
He didn't do any fundamental research. He was a retail investor. Back then, retail investors didn't have, access to as much information as we do today. So, basically he was just looking at ticker symbols, and as they were moving up, he would buy them, and then of course the bottom fell out. He lost all his money. A lot of the companies at the time, they went bankrupt. So it's not even like you could have just buy the dip and hold it and you'll be fine. No, they went bankrupt. So you lose all your money. And so it ended up costing my family a significant amount of stress. And so my entire reason for being in the capital markets is basically to understand why he lost the money, what happened, and then basically do the opposite, so that this way. And whatever my dad lost, I got back like 20-fold. So it's one of those things that you learn life lessons from the people around you. Now, here's the thing. I have friends right now that don't give a shit about the stock market at all. It's never been in their zone. But the thing is, they've never really cared. My first experience in the stock market was a very severe negative one. But I've always been the personality that's like, I want to find out why my dad lost all this money. Not to say that, like he's dumb or anything like that. It's just he got caught in this wave of, hey, I just need to buy this because it goes up. It's the same thing with SPACs. How many people bought SPACs that were completely like, they had great stories behind them, but they were just not good businesses. And I think that's one of the good things in this market right now is that, as far as I can tell, there aren't as many garbage companies. There's actually good, strong companies with good earnings that are real businesses that generate tangible returns. So that's why when you see companies like that get sold off double digits, you should be willing to buy the dip on those.
And I think it's important for people to hear that, because when you come out and you say, hey, I'm not that excited about a name like Tesla, and people just say, oh, he's a bear. People don't realize when you go through personal experiences where someone like your father loses his money in a dot-com bubble, you start to get scared when you see stocks that don't really match the reality of their earnings, which obviously a company like Tesla does not match any reality of their earnings. And that creates some foundational elements to be bearish. But it's not just because you're hating Tesla to hate Tesla, right?
Yeah. It's just whenever you buy something that has like super extended PEs and things like that, it always reminds it, like it internally, there's certain methodologies that all of us end up developing, and then we trade based on that methodology. For me, I'm a combination of tactical and value. So, on that end, I try to find companies that are very undervalued, but then also are technically oversold, and then buy them, and sometimes use an option strategy, sometimes just buy the plain stock, and then, ride the wave higher and lower, so that's it.
Berkshire Hathaway down 4%. So even though Buffett's heavy in cash, he's getting hit.
Yeah. I mean, the thing is, he's got a ton of oxy. Look, not every one of Buffett's picks have gone well either. That's just how things are. Buffett, look at how much money he lost on Kraft Heinz.
He's admitted to that mistake many times.
Yeah. The only person that has never lost money in the stock market, like consecutively, is Stanley Druckenmiller. That's it. That's the one guy. And one of his superpowers, I think Scott Bassett actually said it. One of Stan's superpowers when it comes to investing is that he knows when to cut his losses and move on. Like he does not stay in a company hoping for a reversal. He's just like, nah, screw it. I'm out. Like he finds that trend, and if he sees the trend going the other way, he just gets out. And it's funny because the story that made Stanley Druckenmiller, like at least that gives him nightmares, is during the .com bubble. He saw the bubble. Okay. He was like, this thing is stupid. I'm getting out. So he got out of the .com bubble, but his traders, his analysts, they were still in there and they were making money and they were doing really well. And Stan's like, these motherfuckers are making money and I'm not. What the hell? Like, I need to get in on this. And even though his logic was sound, which is this is a bubble, we need to get out, he literally got in the day that the market collapsed. And he speaks about it till this day. He's like, that is the worst thing. And I think he lost over like $1 billion. That thing,
But it goes to show you how much like even the best of the best can get such FOMO when things get so aggressive to the upside. And they can continue to lose their shit when it hits the fan. 4.4% on the S&P. Are we going to have our first 5% day, Chris?
No, the circuits might end up getting hit. Take a look at on Twitter. I think what's his name posted the circuit breakers. At what point does the market halt? Let me see how.
You could just send me the tweet as well.
Yeah. Circuit. Great.
Yeah, I mean, so that could happen. I see it right here. So here are the circuit breaker. And well, let me say this, then I want you to explain to everyone what is a circuit breaker. So level 1 is a 7% decline. That would create a 15-minute halt if we hit 5,018. We're at 5,011 right now. Or sorry, 5,100 right now. So still have about 1% to go on that, or 3% to go on that. Level 2 would be 4,700 on the S&P. I don't think we get there today. I hope not. And then trading will be halted for 20 minutes. Level 3 would be 4,300. So what is a circuit breaker, and when's the last time you experienced one?
I think it was COVID. I don't even remember when the last time, because I was at the hospital, so I didn't look at my portfolio like that, like as much as I look at it now. But basically, when the markets are in decline, that means that things are panicking and people are panic selling. So these circuit breakers, they basically get triggered and it stops trading for a few minutes to just let things kind of just even out, so that, like algorithms and people and sentiments can catch up, and then things can, level off a little bit. So yeah. Right. Geez, how much value has basically been taken out?
Yesterday was 2.8 trillion got wiped out. Today, I would assume it's getting close to $1 trillion.
Stock market value.
SoFi in the 8s. Wow, SoFi's in the $8. Holy freaking crap, dude.
Hood's in 31. Do you still have those spreads on the Hood?
No, I have spreads on SoFi, and SoFi spreads. Well, I have spreads on Hood too, but SoFi spreads. I bought them for 35 cents. They're trading at 50 cents right now.
That's good.
Well, yeah, they're still up, but at one point they were up a lot more. Hood spreads obviously are down.
I was up 400% on my Carnival spreads, and I didn't sell like a dumbass because I was like, oh, I don't want to pay the taxes.
Now, what would be really sad is I have Robinhood $15, $20 spreads which means by January 2026, I will make a good chunk of cash if Robinhood is above $20.
Yeah.
I mean, I don't know if it's above $20, but I mean, like, I would imagine it is. My gut says yes, but like, it's probably going to test somewhere close.
You got plenty of time. You got plenty of time.
No, that's a good thing. We have plenty of time, but it's like, could you imagine we're at $19 or $18 or something, and those spreads are under pressure? Like,
this is the thing about when you're doing options, especially spreads. Give yourself a good amount of time so that the market can get, like, all my spreads right now, with the exception of one, is all the way December of 26.
Yeah.
You know, so it gives me a lot of room to basically play around if I really need to, going forward, you know. So I think this thing eventually, when it moves away, you know, the markets will slowly find its footing, and then we'll be back up again. So we'll see what happens. Actually, I actually kind of like the fact that the market's dumping hard like this.
Yeah.
That means that the recovery is probably going to be, you know, like a nice, long, drawn out recovery going the other direction once confidence comes back to the markets.
I 1000% agree. Like don't mess around, like, don't beat around the bushes, right? Just get it over with, rip the Band-Aid off, and then hopefully we can recover. But it's tariffs.
Yeah, especially if it's like this, it's like a sideways. Like, the worst case is like a sideways and, you know, moving down market. I'd rather have it just woof rather than you know.
Yeah, because then it's every day you're just waiting for a little bit more of a decline, when in reality the bottom just needs to fall out. Here's the labor secretary on Bloomberg today. Again, Powell speaking in about 30 minutes. Here's what she had to say about the job market report that we got.
Congratulations on your confirmation. Secondly, the jobs report, a blowout jobs report, an upside surprise. There can be no debate about how solid this jobs report is this morning. Where there is debate on Wall Street, as I'm sure you know, is whether this will be the last solid jobs report for the remainder of 2025. There is a lot of worry about policy volatility. What gives you the faith, the hope that we will see more of the same?
Again, for having me. And listen, this is a great day for America. This is a great day for the American worker, and this is a great day for President Trump. I can tell you this, I don't expect that this will be the last positive jobs report. We're going to be on the ground. We're going to be working together. We're going to be focused on the American worker. We blew it out of the water today. And again, as I said, this is a great day for America.
With stocks down 2.5% for Wall Street, they'll struggle to say the same thing. We heard from JPMorgan in the last 24 hours who said there will be blood. Neil Dutter, Renaissance Macro, another well-known strategist on Wall Street, said it's obliteration day, not liberation day. Where are we going to get the confidence to hire in America with sentiment so beaten up over the past month?
Well, again, I don't believe that that's a sentiment across America when you're talking to the workforce. If we grow this economy, if we have positive job growth, people will start to keep more of their hard-earned dollars. They'll start to invest. They'll start to save. And I think you'll see those markets respond. Again, the president went around during the campaign, and he's keeping his promises to the American worker. He is the president of the American worker. We align on that. I'm going to be on the ground starting this weekend in Pennsylvania, talking to the American worker. I want to know what they're doing, what they care about, and I will report and advise the president on the positivity there. And we're going to start to grow this economy as we build the workforce here in America, and we're going to see these numbers continue to rise.
We don't hear.
I mean, yeah, people are obviously not happy.
Uh-oh. Brother, we got a problem. Look at this.
Hold on.
This
you found
is
something new? You found some new data?
Yeah, this is not good.
Okay, what am I looking at? Explain this.
This is credit spreads, right? And basically, credit spreads give you a snapshot at risk. And basically, when the spreads jump up, that means that, like, there's a ton of fear in the markets, and you could actually end up getting a recession. So if you look at, like, the past recessions that we've had and, like, past down markets, 2020, 2016, you saw credit spreads jump because of the issue in energy at the time, energy collapse. Now in 2020, look at this. This was credit spreads during COVID. And then 2022, remember that May, June thing that we just spoke about? And then last August, we had credit spreads go up. So if credit spreads keep rising, look at this giant move in one day. Yeesh, that's not good. It's above It's above August.
Okay, so if is that temporary in your opinion, or how do you think why do you think the market is widening the spread right here?
I don't know, but it just means that like risk on is like people are taking this a lot more seriously. Like the market is like pricing in a recession now at this point. Like, yeah. So I think someone else posted this on Twitter. Let me just show you guys what I here. Twitter. This right here. Yeah. The Trump admin better do something. So this is credit spreads. Look at this. Regional bank crisis. This was in 2023, and this is us right now.
Yeah, I mean that is absolutely the market saying we think there's a shot of a real recession now.
Yeah. So this is where either the Trump admin blinks, especially what is it, April 4th today, so April 9th. This is where the Trump administration either blinks or they're serious about taking us into a recession, and we basically are going to deal with a recession.
S&P 500 right here, down 4.28%. Tesla down 9%. Hoodie 15. There's really no green candles at all. I mean, like even Nvidia continues to just get hit. It's not like there's any level of buying that's stepping in right now, which I think is the scariest part about this.
Yeah.
Bart, thank you for the 60 euros. Appreciate that, brother. Just bought $100,000 of Robinhood. Bart from Belgium. Bart, thank you for the super chat. And I mean, yeah, look, this is what Chris and I have been talking about all day. You can't hate that move. And anyone who hates that move is trying to say that, all right, you're not going to get the exact bottom on Hood. Maybe you don't. But now down 50% from the top, down 15% on the day. Could it go lower? Of course. But I don't think you can blame anyone who nibbled here today or yesterday. People can make fun of people who bought the dip or whatever. It's like, that's fine. But these are the days where you at least take a little bit of a nibble, and we just have to see how bad it gets.
This is kind of funny. One of the things is when foreigners start to buy U.S. stocks, that's usually a sign that we're at a top. And believe it or not, it ended up happening again. Look at this.
Yeah, no, you're right.
I saw this, and I right here. It's like the bear markets. They usually get right in at the top before things go down. And it happened here too. Like the only time is like COVID. Oh, geez.
It is ugly. I mean, freaking J-Pow. I wonder how he's going to talk about all this today.
Yeah.
This is
I mean, anyone here who's got a mortgage that they bought a house recently, you guys could refinance a little.
Can we talk about that? Is the housing market going to crash with stocks right here, or what's going to happen? What do you think is going to happen?
I mean, okay, so my theory on shelter, as a foreigner, Chris, isn't it wrong? My theory on shelter has been that one of the reasons why we've had this lockup in the shelter market, basically, all these people got sub 3 mortgages, and they're sitting on these sub 3 mortgages. And the thing is, they want to sell, they have to move, but they can't do it. So a lot of people are just been renting instead, or trying to rent. And there's a lot of inventory that's sitting on the sidelines right now because people want to, move up the house chain, down the house chain. Maybe you need a bigger house, maybe you need to downsize, but you're locked in place because of that mortgage that you have. Now, the challenge is if you sold your house right now, at 3% mortgage, and you basically buy another house, you would end up getting a 7% mortgage. So, you're not going to do that. The economics wouldn't make sense for you to do that. So what you're essentially going to do is wait it out. And so the more interest rates come down, the more likely it is that you'll actually put your home on the market and basically be willing to buy another house. And so that transaction volume should help theoretically, So maybe that's why Rocket Companies is up.
Yeah. Well, yeah. So let's talk about that. Why do you think why is a mortgage company up right now?
Because they make their money on services, where basically the more people buy and sell homes, these guys do the mortgage issuance, and so they collect service fees for mortgage originations. So if interest rates are coming down, that means that more people that have been sitting on the sidelines to sell are also going to be there, but then there's also going to be more people on the sidelines willing to buy. And this is where they make their money. The more transaction volumes there are, the more service fees these guys are able, the origination fees and mortgage servicing fees they're able to collect also, because they're actually a servicer as well.
That makes sense. And I guess that's a little bit of a pocket of safety along with some of the telecommunication companies. But
well, I wouldn't say it's a pocket of safety, to be honest with you, only because if there's a reversal in inflation and we end up getting stagflation and interest rates start going the other direction, then these guys will end up getting hit too, because that means that we're kind of stuck. So, I mean, I don't think that's the case. I think they're going to be, they're going to be fine. I think people really do need to sell homes and buy homes. Like my brother-in-law, he just sold his house for about $100,000 over what he bought it for in 2022. I mean, it's a $700,000 house. He sold it for $820,000. The thing is, though, that house had a mortgage of 3%. He had to buy another house because of his wife had to move, and basically, because she took a job somewhere else. And his new mortgage is like 7%.
Yeah.
So he's eating the cost right now. I mean, they're wealthy, so it's not a big deal. But basically, a lot of people are having to make that choice. And a lot of people bought houses in rural areas that either they tried to put on Airbnb and tried to be Airbnb landlords, and that's not working out so well for some people. And then there's also a whole bunch of people that moved because of, like work from home. And now a lot of people are being called back into work and saying, you can't work from Des Moines anymore. You have to come back to Silicon Valley, and that might cause some issues. Like Florida and Texas are the epicenters of a real estate correction right now.
So, okay, here's another question. Someone asked the super chat right here. Thank you for the $5. Essentially the extent of this question is, hey, what if the job market is more suspicious than not, aka people have multiple jobs, the JOLTS number is not really that accurate. If we do get an issue with jobs, that's when it's real Armageddon, right? Because if we lose job growth, it's over.
That's the real recession, because the cascading effect of unemployment is massive. So imagine right now, like, let's say there's 1 million people that lose their jobs. Those 1 million people, they're not buying additional stuff. They're not going on vacation. They're not, spending excess capital on things. They're basically living to survive. Now, the thing is, the downstream effects is that there's people who basically serve those people and serve the, or make things that those people consume. They're going to lose business. And if they lose business, they're going to do layoffs. And then those people are now going to basically have another downstream effect after that. So usually unemployment is like the worst case thing that can happen. So more people lose their jobs, the less demand is out there for goods and services, that compounds on itself, and then it becomes a massive wave of issues. So usually what you want to do is when unemployment starts to climb, you kind of want to stimulate the economy. You want to get job growth out there. You want to lend money to businesses. You want to have governments hire, local and federal government hire more, so that this way you kind of stop that thing from compounding itself. That's not an issue right now from the data, because we can see the job numbers are fine. I mean, even with all the federal workers that have been laid off and everything else, that hasn't shown up in the unemployment data just yet. So
we are seeing some green candles, folks. Nike just went green on the day. S&P, there's your green candle right there. That's followed up across Palantir, SoFi, Tesla, Robinhood, etc. I don't see any news. J Powell is not speaking yet. Maybe market got a little bit of a whiff of what he's going to say.
Trump just had a very productive call with Lam. Lam told me Vietnam wants to cut their tariffs down to 0 if they're able to make an agreement with the U.S.
Oh, let me read it. All right, here's the tweet. Just had a very productive call with To Lam, General Secretary of the Communist Party of Vietnam, who told me that Vietnam wants to cut their tariffs down to 0 if they are able to make an agreement with the U.S. I thanked him on behalf of our country and said I look forward to meeting in the near future.
Well, there you go. Now the announcements are going to pour in over the next few weeks, and hopefully that's our saving grace.
But Vietnam 2 days ago, before the April 2nd announcements came out, already said they're willing to do this. So
I know these are small victories. These are headline grabbers, dude. Trump knows Trump is like a PR expert when it comes to this. He's basically going to take a small victory and turn it into a big victory and basically sell it to the American people, you know.
Yeah, I think that's how it's playing right now. Yeah, so this is not really I mean, I don't know if that's causing some of these green candles, but
Treasury, another new headline just came out. Treasury Secretary Bessent is trying to quietly moderate Trump's hardline stance on trade by Fox News.
I'm trying to, okay, so I don't think they interviewed him. They must have talked to a source. That could be another headline, right? If Bessent's trying to get Trump to ease up, that's good. That's not bad. Bessent quietly moderating Trump's hardline stance on trade. We don't know if this is true or not, but yeah, I mean, maybe that's part of the reason for the green candle, or maybe the market, a little bit of Jay Powell's comments have leaked, and maybe they're super dovish.
Yeah, I mean, this is what I mean, man. That stupid idiot Lutnick. They should. I'm telling you, man, this is because of freaking Lutnick. If Scott Bessent was there, he would have just said, look, do 10%, and the market would have rallied.
Yep.
You know, and you still would have been able to generate a significant amount of tariff revenue because most of the suppliers would have just ate it and the countries would have just ate it. You know.
Nintendo is delaying pre-orders for the Switch 2 in the US due to new tariffs announced by President Trump. Well, all the gamers out there.
Yo, how's Take-Two Interactive doing? I got to find that. That's the Take-Two is at 203. Damn, this thing just will not come down, bro.
Steve just called me a couple minutes ago. Let me see if he picks up. Let's see if we can get him in this. I guarantee if I ask Steve, what does he think? He's gonna be like, oh, I don't care. I'm a long-term investor. That's which is the right answer, but it's like that's probably what he's gonna say. Palantir down 9. But yeah, we're getting some green candles, guys. I mean, even Tesla 239 to 244. S&P as well. It's not 4.7% down anymore. It's 3.6%. Not sure why. Not sure why. Right, Steve's not picking up yet. Jay Powell speaks in about 15 minutes, and then we'll get a better understanding of what's happening there. Someone says, Amit, any idea of why gold is diving? Isn't it supposed to be the safe bet when the market is tanking? Chris, want to take a stab at that?
Yeah, maybe. Oh, someone just commented, Scoop, I've heard from Wall Street sources close to Trump White House that Secretary Bessent is trying to moderate, albeit quietly, the president's hardline stance. If he ramps it up, it would be the first significant in-house battle in the new administration, pitting Bessent against Howard Lutnick. Wow. I fucking called it, dude. I called it, dude. There's definitely internal struggles in the administration right now, and this has actually been happening since November. I don't know if you saw that. Like, let me see. Hold on.
I'll pull this up right now.
Because what is that thing called?
Real quick for the gold question right here, I think people are just really afraid if they're not buying gold, right? So that's why they'd rather be in cash than any level of risk at all. Yeah, so Fox reporter on X says, I've heard from Wall Street sources close to the White House that Bessent is trying to moderate quietly Trump's hardline stance on trade. If he ramps it up, it would be the first significant in-house battle in the administration, pitting Bessent against Lutnick. Dude, if this is the debate that happens internally, one of them is going to be out of there.
Yeah, I mean, this was the headline from there it is from November. This is like before the
really they had beef in November.
Yeah, because Lutnick wanted to be Treasury Secretary.
Do you think that would have been better for us if he got to be in? Is that more?
Hell no, dude. Lutnick's a fucking moron. He said the reason why Europeans don't want to buy America's beef, like, it's because U.S. beef is beautiful. Was it strong and beautiful, and European beef is weak? Like, what like you gotta hear this guy, bro. He's a freaking moron. Like,
well, he's our commerce secretary. Nike right here up 3%. Again, S&P, there's that itty bitty sign of hope with that green. The bottom's not falling out as much as it was 20 minutes ago. But now it'll.
Chris, stop talking like that, bro. I'm sorry. I grew up in a time where the R word, we didn't call it the R word. We just said retarded. I am sorry to anyone who is the R word. I don't know what's the word? Special needs? Is that you? I feel like special needs.
You're digging
is
yourself in a digger hole. You might as well just not even justify it, dude. You're gonna do what you do. That's it.
Yeah.
Yeah, it is pretty ugly right now. We got 15 minutes until J Powell speaks. Let's get a little bit more of an update right here, and then we will have J Powell pretty soon.
Yeah. Well, this goes to show that any moderation in this tariff thing, the markets like it. And so if the Trump administration really felt that, you know what, it's time to blink on this and let the markets rip, all he has to do is basically just say, you know what, maybe we don't need as many tariffs, or he just needs to dial back his tone and the markets will rip higher.
Yeah, the harder the fall, the easier the recovery if any positive headlines come out.
Mm-hmm.
We're not anywhere near some of the worst kind of concerns about consumer credit default swaps or those.
Industry relies on a strong economy, and as recession fears worsen due to this trade war, investors are going to sell bank stocks. Today, you can see shares of the big 6 U.S. firms adding to yesterday's steep declines. However, the volatility could benefit firms with sizable trading businesses, particularly in the equity space, FX, and commodities. And bank earnings kick off 1 week from today. So we'll not only get color from the executives from these firms, but we'll also get a sense of how they're assigning the probability of a slowdown based on what.
Trump just tweeted about the Fed. Here we go. Trump, this came out 2 seconds ago. The tweet is, this would be the perfect time for Fed Chairman Jerome Powell to cut interest rates. He is always late, but he could now change his image and quickly. Energy prices are down. Interest rates are down. Inflation is down. Even eggs are down 69%. He definitely used 69 for a reason. And jobs are up all within 2 months. A big win for America. Cut interest rates, Jerome, and stop playing politics.
Jesus Christ, dude. This guy, man. This guy, now he's putting pressure on Powell to cut.
And he's saying this 10 minutes before Powell has to speak.
Talk about putting the guy in a bad place, man.
I mean, it's not easy to navigate that.
But you know what? This does show you something, that Trump cares about the market. Screw him when he said, "Oh, don't look at the markets." Nah, bro, he's looking at the markets. He's like, "There's no way I want to deal with answering the CEOs after they've lost 25% of their market cap."
Yeah.
You know? Yeah.
Oh boy. Oh boy. Oh boy. Oh boy. This is going to be pretty interesting to see what happens with.
This is just the speech. It's not a cut meeting.
No. It's just he's at some economic club.
Yeah, he's just. We'll see what happens.
He's not even supposed to be expected to say anything that game changing, but now everyone's going to be listening to every single syllable with what he says.
They do,
bro. If they
and how much they're reserving for soured loans. Alternative asset managers have more direct exposure to tariffs through their portfolio companies, many of which are in industrials and energy and consumer and other places that are adversely impacted by these policies. And due to the leverage on these companies, the publicly traded firms tend to have a magnified response. And these headwinds make an already challenged environment for exits, sales, and IPOs relatively untenable. Carlyle, KKR, Apollo, each losing more than 20% in 2 days alone. Now, to be sure, lower rates are helpful for deployment of their capital because they make the cost of financing cheaper. And it's also worth noting that publicly traded alts generated huge gains in the stock market last year. So they are an easy target in this environment for crystallizing gains in a downturn, guys.
We think about the private equity community, Leslie, as I would argue very robust backers of the president during the campaign. And when we talk about what elements might be pushing back on the Oval, whether that's GOP senators or corporate leaders, it's hard to imagine that these wouldn't be part of that conversation.
Oh, absolutely. Using their influence there. Publicly, we've heard pretty much by and large across the financial services industry, broad-based support. It's obviously a spectrum. Not everybody feels the same way. A lot of discussions about uncertainty without pushing back on specific policies, and a big.
Here's JPMorgan on these tariffs this morning right now. We got about 10 minutes until Powell speaks.
Global strategist David Kelly. There will be blood was the title of one report last night.
Yes, from our investment bank. I mean, I want to make it clear. I think that there is at least a 60% chance of recession if these tariffs stick. And I know, one scenario is that different countries try to negotiate them down. An even better scenario, of course, for markets would be if the president decided to postpone the implementation of reciprocal tariffs while he goes country by country and thinks about it. Because if we got a tweet, in the next, at any point, which said, okay, we're going to go back to 10% across the board, and we're going to look country by country to reciprocal for whatever reason. If we saw that, then I think the markets would recover. 10%'s not good. By any means. Tariffs generally tend to slow the global economy and hurt the market, but it's a whole lot better than what we're looking at right now.
You're kind of mind melding with Lloyd Blankfein, who tweeted a moment ago, as we said, make the 10% minimum tariff immediate, but defer the reciprocal part 6 months. Take the win. President said he'd make us tired of winning. I'm there now, is what Lloyd argues.
Yeah, they're very sensible. And then if you go through, I mean, tariffs are bad, so there's nothing wrong with saying that Europe needs to get rid of its tariffs. The best reciprocal tariffs are 0-0.
That's a good point right there, because I don't think anyone disagrees that America's getting ripped off by a bunch of these tariffs. Like, philosophically, we need to do something about it. It's just, I think the market hates the way that Trump has gone about imposing the reciprocal tariffs.
Dude, it's the number. It's the number that I'm telling you. That's like the 40-50% like shock and awe number. That's what the markets hate right now. Had they just done 10% across the board, right, with like phase-ins and phase-outs, bro, the market would have ripped higher, So,
Yeah.
And I think that's what's going to end up happening. I think right now, Nike's already up 5% after that conversation with the Vietnam general secretary. I mean, this is, in my opinion, this thing was man-made, and I think it can be man-unmade.
Yeah, I agree. It definitely can be man unmade. And Trump's ready to probably unmake it and act like the savior. But as of now, the market is dealing with the fact that
the thing is, and a lot of these countries, they're gonna say like, yeah, we'll lower our tariffs. Like, what, our 2% tariff on your thing? Like, it's the dumbest thing, man. I'm telling you, a lot of this is just symbolic victories that the Trump administration is trying to get, so that basically they can say like, look, we got this done and we got that done.
Yeah.
So
absolutely, and really, we should not be using tariffs as a revenue source. It's the most destructive of taxes. There are other ways of raising money. Tariffs are really the worst way to raise money.
But they have framed it as a revenue engine.
Yes, unfortunately, they have. But the problem is, first of all, it's a very regressive tax. Tariffs, even more than the sales tax, the poor and lower income households pay a greater percentage of tariff taxes than say income taxes. So that's one thing. But second of all, it just slows down productivity. It slows down global commerce. I mean, the United States can so flourish. We're the best in the world when it comes to competing in free enterprise. Why not take advantage of that? And I feel like I'm echoing something that Milton Friedman or Ronald Reagan would have said. I feel like this is the most conservative viewpoint you could take, is let's flourish under free enterprise. That's what we should be doing.
But that President Trump channeled, I think, a lot of frustration, particularly in the industrial Midwest, where jobs have left and manufacturing share has gone to China.
Yes.
He campaigned on it. And I think that he's there, and he feels he has survived 2 assassination attempts in order to do this and level the playing field.
But it's so important to understand what actually causes our trade deficit. You've got to get the pretext right. There are 2 things causing our trade deficit. One, for years, we've supported the idea of we want a strong dollar. Why do you want a strong dollar? I mean, the dollar is not our national flag. You fly the stars and stripes as high as possible, but the dollar should be at an appropriate level for your economy. The dollar's been too high. And second of all, we run a big budget deficit. And it is a mathematical certainty that if the private sector is balanced and the government spends beyond its means, then the country will import more than it exports.
Yes,
You'll have a budget.
The logic, is not rooted in economics.
But if that is what is causing the problem, then address those 2 things. I fully support the administration's view that we ought to bring the dollar down. We should bring the dollar down, and we should bring down other people's trade restrictions. And I think we have the bargaining power to do that. But please don't put tariffs, build walls on global trade, because that actually slows everything down and makes people poorer.
So do you think?
We'll get back to that in a second. Quick headline: Klarna, Wall Street Journal, is saying they are pausing their IPO until after the Trump tariffs. I mean, they were supposed to IPO, I think, in about 2 weeks, 3 weeks. So, Chris, you're muted, by the way. The fact that they're postponing this, I think, is telling as well.
Congress is also starting to push back. Bro, you got like enemies getting together and saying we need to roll back these tariffs. Let me just play this real quick for us. Just screenshot.
Where's the VIX? The VIX currently is still up 25% on the day.
Small businesses, and I've heard it firsthand, they are being gutted by dumping cheap goods that produced by cheap labor overseas. We have to end that, and that's what President Trump's doing.
It is estimated that the average American family will pay more than $5,000 out of their pocket to pay for these tariffs. We're going to fight these tariffs tooth and nail.
Welcome back to Special Report. Tonight, our Common Ground segment focuses on the Trump tariffs, the reciprocal tariffs. Joining us, Virginia Democratic Senator Tim Kaine and Kentucky Republican Senator Rand Paul. Thank you both for being here. Senator Kaine, you've got this resolution, this proposal that blocks tariffs on Canada. Explain what this is, this joint resolution, and obviously you have some Republicans signing on.
Absolutely, and I'm really happy that Rand Paul is a co-sponsor. We are opposed to the Canada tariffs for two reasons. One, we don't like tariffs, especially broad-based, generally applied tariffs. And two, we don't like government by executive emergency declaration. Trade is an Article I power for Congress. Congresses of both parties have delegated too much of this power over to a president. But when a president says Canada is in an emergency status and we need to impose a tax on the say-so of one person, we're using a little used Senate procedure to stand up and challenge the president's declaration and imposition of these taxes.
Senator Paul, you hear the president saying it's not fair what countries are doing to us on a host of different products, and he does single out Canada of what they've been doing on different products up to 100, 200% on some of them. What's the rationale for getting behind this?
Well, one, we should not live under emergency rule. The Constitution said taxes are raised by Congress. Most specifically, taxes originate in the House and come to the Senate. So I'm against emergency rule. But on the tariffs in particular, on the idea of trade, trade is proportional to wealth. The last 70 years of international trade has been an exponential curve upwards, and the last 70 years of prosperity has been upwards also. We are richer because of trade with Canada, and so is Canada. Whenever you trade with somebody, when an individual buys somebody else's product, it's mutually beneficial or you wouldn't buy it. If the trade is voluntary, it's always beneficial. There is no Canada versus the U.S.
You're muted.
I stop that. But so this, in my opinion, is something that all of these CEOs from local states are going to be calling their senators. They're going to be calling their House reps and saying, look, you need to get Trump to take this out. Otherwise, you're going to have a problem. And the thing is, every one of them can lean politically on these guys. And eventually, I think Trump is basically going to have an internal party revolt if this thing keeps going on the way it is. So I don't think that the party is necessarily as unified as people are making it out to be at this point.
Yeah, I agree. I mean, Tim Kaine and Rand Paul coming together is pretty telling. Also, I mean, look, like a lot of Republicans got elected by Trump, but there are Republicans that have been willing to go against him in the MAGA base. And so if tariffs do lead to more economic issues, those Republicans are going to seem more like the people that have the quote unquote best interests of Americans in mind. And it might put some pressure on Trump to reverse this, but obviously time is going to tell.
Yeah. Did you see the video from Javier Milei about explaining how tariffs are actually very regressive?
I saw the tweet. I did not watch it.
Here, let me put it on real quick. Yeah.
Okay. Powell is speaking in 1 minute. I will switch to Powell when he speaks, guys. He's not live. It might take a couple minutes for him to get live, but as soon as he goes live, we will switch to Powell.
Suponete lo siguiente.
que yo tengo una empresa, ¿sí?, que produce, por ejemplo, productos textiles y que la importación, digamos, me está lloviendo la importación de Pakistán. Entonces, pido que me den aranceles de un 600%, o sea, que el precio se multiplique
traben la importación.
claro, por 7, porque si no yo tengo que echar, no a 200, a 600 familias. Entonces vos decís, uy, mirá, digamos, claro, si vos abrís la importación, vas a hacer quebrar a esta empresa, ¿sí? Y vas a dejar 600
Pero no
personas.
pasó eso, por ejemplo, en los 90.
No, fíjate, este es el punto. Cuando vos abrís la economía, es claro que el que no es competitivo va a quebrar. Pero también lo que vos vas a ver es que en ese sector se destruyeron 600 puestos de trabajo. Lo que vos tenés que mirar es esto, que esa persona que tiene que gastar en ese bien textil, ¿sí?, en lugar de gastar 700 ahora, va a gastar 100. Y le quedan 600 para gastar en otros sectores de la economía, con lo cual va a estar creando empleo en otros sectores de la economía. Entonces vos vas a tener una ganancia de bienestar por varias cosas. Por un lado, porque vos vas a estar aplicando los recursos a sectores que son más productivos y por ende los salarios reales van a ser más altos. ¿Por qué? Porque te van a pagar más salario por ser más productivo y porque además vas a estar comprando bienes a precios más bajos.
Yeah, he is not a fan of those tariffs, and he's making the same argument that a lot of people have been making over the past couple of days. Powell should be live in about 2 minutes. Let's get to that, and then we'll get started.
Certain that a one-time increase in the price level does not become an ongoing inflation problem. That speaks to at least some hesitancy in raising rates or in cutting rates in response to weakness. He says, though, it is too soon to say what the appropriate path of policy will be. Policy, he says, right now is well positioned to deal with the risks and the uncertainties. And uncertainty, he says, is high. Downside risks have risen. However, the economy is still in a good place, a phrase he has used often. Incoming data shows solid growth, a labor market that's in balance. He says today's 4.2% unemployment rate is still low. Surveys report dimming expectations and higher uncertainty, but he's closely watching this tension between hard and soft data. I believe he's sitting down now. But again, I think this is a somewhat perhaps hawkish view in terms of him saying he's going to make sure that.
That's the headline. Powell looks pretty hawkish based on these comments. He thinks tariff inflation is going to be pretty bad. That's the headline currently right now before he goes live.
First of all, the big changes and the fact that they were worse and significantly, I think you used the word, Steve, more than expected on the tariffs, but also the fact that they have to be really vigilant on making sure that inflation is not lasting. I mean, yes, it wasn't him saying we're going to have to cut rates preemptively, like maybe some would be hoping for, but that would also be a little tough for him to do at this point.
Yeah, he can't do that, Sarah. But the key here is what you were expecting. Okay, so if you were expecting the Fed to act and act quickly, I will tell you that the May, for example, probability of a rate cut has gone down from 48 down to 42%. Some decline in the idea of a first rate cut in June, which was up near 90. It's now still around there, but it's down just a little bit. The key here, to my mind, Sarah, and I can understand how he's now speaking. Maybe we want to go listen to Jay Powell now. Debate it later.
That greater understanding. And I do want to start by thanking all of you for the work that you do, which is incredibly important, and we do appreciate that at the Fed. I'm sure that this room full of reporters does not lack for questions to ask, and before answering a few of those, I'll briefly summarize the outlook for the economy and monetary policy. At the Fed, we are squarely focused on achieving the dual mandate goals that Congress has given us of maximum employment and stable prices. While uncertainty is high and downside risks have risen, the economy is still in a good place. The incoming data show solid growth, a labor market in balance, and inflation running much closer to, but still above, our 2% objective. After a couple of years of solid growth, many forecasters have anticipated somewhat slower growth this year. The initial reading for first quarter GDP will be released later this month. The limited hard data are consistent, though, with a slower but still solid growth outlook. At the same time, surveys of households and businesses report dimming expectations and higher uncertainty about the outlook. Survey respondents point to the effects of the new federal policies, especially related to trade. We are closely watching this tension between the hard and the soft data. As the new policies and their likely economic effects become clearer, we will have a better sense of their implications for the economy and for monetary policy. Looking across many indicators, the labor market appears to be broadly in balance and not a significant source of inflationary pressure. This morning's jobs report showed the unemployment rate at 4.2% in March, still in the low range where it has held since early last year. Over the first quarter, payrolls grew by an average of 150,000 jobs per month. The combination of low layoffs, moderating job growth, and slowing labor force growth has kept the unemployment rate broadly stable. Turning to the other leg of our dual mandate, inflation has declined sharply from its pandemic highs of mid-2022. It has done so without the kind of painful rise in unemployment that has often accompanied periods of tight monetary policy that are needed to reduce inflation. More recently, progress toward our 2% inflation objective has slowed. Total PCE prices rose 2.5% over the 12 months ending in February. Core PCE prices, which exclude the volatile food and energy categories, rose 2.8%. Looking ahead, higher tariffs will be working their way through our economy and are likely to raise inflation in coming quarters. Reflecting this, both survey and market-based measures of near-term inflation expectations have moved up. By most measures, longer-term inflation expectations, those beyond just the next few years, remain well anchored and consistent with our 2% inflation goal. We remain committed to returning inflation sustainably to our 2% objective. Turning to monetary policy, we face a highly uncertain outlook with elevated risks of both higher unemployment and higher inflation. The new administration is in the process of implementing substantial policy changes in 4 distinct areas: trade, immigration, fiscal policy, and regulation. Our monetary policy stance is well positioned to deal with the risks and uncertainties we face as we gain a better understanding of the policy changes and their likely effects on the economy. It is not our role to comment on those policies. Rather, we make an assessment of their likely effects, observe the behavior of the economy, and set monetary policy in a way that best achieves our dual mandate goals. We have stressed that it will be very difficult to assess the likely economic effects of higher tariffs until there is greater certainty about the details, such as what will be tariffed, at what level, and for what duration, and the extent of any retaliation from our trading partners. While uncertainty remains elevated, it is now becoming clear that tariff increases will be significantly larger than expected. And the same is likely to be true of the economic effects, which will include higher inflation and slower growth. The size and duration of these effects remains uncertain. While tariffs are highly likely to generate at least a temporary rise in inflation, it's also possible that the effects could be more persistent. Avoiding that outcome would depend on keeping longer-term inflation expectations well anchored, on the size of the effects, and on how long it takes for them to pass through fully to prices. Our obligation is to keep longer-term inflation expectations well anchored and to make certain that a one-time increase in the price level does not become an ongoing inflation problem. We'll continue to carefully monitor the incoming data, the evolving outlook, and the balance of risks. We're well positioned to wait for greater clarity before considering any adjustments to our policy stance. It is too soon to say what will be the appropriate path for monetary policy. We understand the benefits of a solid economy where workers can find jobs and inflation is low and predictable. We also understand that elevated levels of unemployment or inflation can be damaging and painful for communities, families, and businesses. That is why we at the Fed will continue to do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Thank you for being here. This feels like quite a moment to be speaking with you, and I want to thank you for your time. He's got it. I want to thank you for being here, and thank you for taking the time to speak with this group of business journalists. Also like to give a special thanks to Heather Wong with the Washington Post, who helped make this event possible. So for starters, sir, how's your week been?
Just fine, thank you.
Care to elaborate?
So far, so good.
Chair Powell, yes, thank you so much for being here and taking our questions. You were talking about the economy as being a very strong economy. You characterized inflation as coming down, employment as being very strong still. However, President Trump earlier this week, when asked about the market volatility we've been seeing, said the volatility was, quote, to be expected. This is a patient that was very sick. We inherited a terrible economy. A lot of voters did and do agree with that assessment, or at least in part. I'm wondering how you would respond to that assessment and the disconnect between the story of the data and the way a lot of people are feeling about the economy.
Sure. So let me just be clear at the start. I make it a practice not to respond to any elected officials' comments. So I don't want to be seen to be doing that. It's just not appropriate for me. But the situation, I think, is this, and people, when they're surveyed, they are unhappy about the economy. That seems to largely reflect the increase in the price level that happened when inflation was high, 2021, 22, and 23, largely. Inflation is now back down to much more normal levels. Unemployment is low. The economy has been growing, but people are still experiencing that high price level. In other words, prices don't go down. They know they're paying much more for the basic necessities of life. And they're right that they are, and they're not happy about it, and they're right not to be happy about it. So I think that accounts for the negative sentiment. We, of course, we're looking at inflation, which is the change in prices, and we're seeing that that has come down quite a bit, and that, you know, unemployment is actually low. It's sort of very close to measures of maximum employment, and the economy is growing. So all those statistics are good, but you know, the price increases of the past few years are weighing on people's budgets.
So I'm from Milwaukee, and I've been talking to business leaders, executives, and consumers in our community, in our region, for the last few weeks, mostly before this week's news. Chairman, they're troubled and they're nervous. One business owner told me, if there's a hint of a recession, we're cooked. And he asked me to share that with you. What's your response?
So I guess I would say, let's start with the fact that the incoming data right through this morning's employment report, which admittedly is from roughly a month ago, the week of March 12th, they took the data in. It still shows us a solid economy. Unemployment's still low. I understand the uncertainty that's weighing on people. You ask about a recession. We don't actually, we don't make a probability forecast of how likely it is for there to be a recession, but many outside forecasters do, and many of them have raised the likelihood, albeit from very low levels. It's not something that anybody now is forecasting, or some people are starting to. And so there's not much more I can say about that. I realize that the uncertainty is high, you know, what we've learned is that the tariffs are higher than anticipated, higher than almost all forecasters predicted. We're just we still don't know where that comes to rest, though, and we're just going to have to see that through.
At a congressional hearing last year, one of the U.S. representatives said that you were pretty boring, and you thanked him and said that you considered that a very high compliment. And in fact, I feel like it's one of the roles of the Federal Reserve, especially since the housing crisis, to be kind of a ballast, especially in the face of the volatility of the markets and the dramatics that we can experience with the economy. Very steady, no surprises, very reliable. In a moment like this, which also has a lot of drama and unpredictability, but it is not necessarily from an economic crisis. It's by design, it's political. How do you see your role in this moment?
So I think all of the values that you touched on are, in fact, the values that we try to live by. You know, we're driven by, you know, analysis and careful thought and discussion and debate and the merits of things. We try to stay as far as we can from the political process. We don't look at political cycles or things like that. So, and I think people expect that from us. They expect us to tell the truth, and that's what we're going to do. But at the same time, we don't want to be part of the broader political discussion about the wisdom of policies that are not assigned to us. We're not responsible for trade policy, immigration policy, fiscal policy. So we don't comment on those. Decisions are made by others, and what we do is we use our tools to try to achieve the goals that Congress assigned us, which is maximum employment and price stability. So I like to think that over time we're a source of calm, rational analysis and also of stability. That's really what the business that we're in is, providing financial and macroeconomic stability to the public. That's really our purpose.
So how can businesses and individuals and the Fed make plans for the future when so much is being dictated by the actions of a single person? And do you see yourself as the consoler-in-chief on economic matters?
No, I think, take a step back. What's happening is, as I mentioned, the new administration is making significant policy changes in trade, immigration, fiscal policy, and regulation. And you're still just a couple of months into the administration, and that process will take place. And at a certain point, the new policies will be on the table. They will be having the effects they're going to have on the economy, and uncertainty will decline. Right now, there's a lot of uncertainty about where all that's going to sort out, the forms it will take, and what the economic effects will be. If you fast forward a year from now, the uncertainty should be much lower. The actual effects of the policies should then be pretty manifest and clear. So I think I understand why it just is highly uncertain, both what the policies will turn out to be, exactly what they'll turn out to be, and also what their effects will be in the near term. We just have to go through that process, and it is just kind of a manifestation of our election cycle and a new administration coming in with new policies.
I mean, given all of the change happening and the fact that we are in a period where things have not settled in yet, and that the Federal Reserve and you as chair are very projection, data-driven, policy-driven, how do you handle a moment like now? I mean, can you tweak your plans and projections? Do you just do you have to reset them?
So, what we've had since in the last few months is from the staff has been a placeholder. Rather, they wouldn't call it a forecast because it's so uncertain. They call it a placeholder. And that's kind of how we've been thinking about it. So it's a good time to take a step back and let things clarify. That's why it's just too soon to say what the appropriate monetary policy response will be to these new policies. It is just too soon to say. We can't say with any confidence today. So that's what we're doing. We've taken a step back, and we're watching to see what the policies turn out to be and the ways in which they will affect the economy, and then we'll be able to act. Fortunately, our policy stance is in a good place for us to do that. We're probably moderately restrictive, let's say. So it's not really tight policy, but which is appropriate since inflation is a bit above target. So we think we're well positioned to address whatever may come. And in the meantime, I'd say we're waiting for greater clarity before we consider adjustments.
Business owners in Wisconsin have told me that they can't make their plans. They want to expand. They want to build a new facility. They want to hire or do whatever the future calls for. They say, we're trying to look around the corner. We're not even sure where the corner is, and we're not even sure what's around the corner. Sounds like they're in the same position as you are a little bit.
No, we hear the same thing. Of course, we have an incredible network of contacts with businesses and also universities, nonprofits, all different sectors, through the reserve banks and also through the Board of Governors. And that's what we hear. But again, it's a process. We're going through it, and I think we will know when we know what the policies are exactly and what their implications will be for the economy. That will all become clear, and I think that'll be a time when people can make decisions. In the meantime, though, I get it. We're hearing that a lot from people, and we are kind of in the same place, which is waiting for clarity about what our policy path should be. We'll have to see.
As you're talking about placeholders right now and having something in the place when there's so much that we don't know, it does occur to me that this is not the first economic shock that you have steered the markets and the economy through. Obviously, there was COVID almost exactly 5 years ago. It seems similar in certain ways with a lot of uncertainty, a lot of shock, also potential disruptions to prices and to supply, which is very much in the Federal Reserve's wheelhouse. I mean, from where you sit, can Liberation Day be compared to kind of the economic effects of COVID? Are they totally different, somewhat related?
I think each situation is different. you know, there was COVID. There was also then, in the response to COVID, then there was high inflation, and then there was soft landing, and then there was, and now we have new administration and changes in policies. And every situation, you know, it kind of rhymes, but it's not exactly the same thing. And so in this situation, what we face is what I mentioned in my remarks is you actually have risks for higher unemployment and higher inflation, and that's difficult for a central bank because our tools, which consist of interest rates, you know, either slow down or speed up the economy over time. And you know, higher unemployment would call for speeding up the economy, and higher inflation would call for slowing it down. So you can be in a situation, if we find ourselves in that situation, we look at how far each of the two variables is from its goal, and we ask ourselves, how long would it take to get back? And we weigh those things and make a decision about what to do. But there's no question that's a different situation, very difficult situation. When we faced high inflation, it was painful for the country, painful for the people that we serve, but we knew what policy needed to be. We knew we needed to raise rates quite a bit. During the pandemic, we knew what we needed to do. It was very clear the direction that we needed to take with force, and we did.
It's almost a situation potentially where the dual mandate is at odds with itself.
The two goals are, as we say, in tension, or they may be. I'd say that's not what we're seeing right now, but it's the effects at the margin right now would be for higher inflation and perhaps higher unemployment, but that's a marginal effect. I would say you're not in a situation like we were in the 1970s where the two goals were really both pulling in opposite directions and required. That's where, you know, it's just very hard for a central bank to be the answer to a situation like that. But that's not the situation we're really in today.
One of the questions from the audience that we had is, if unemployment takes off and inflation takes off, which lever do you go for? Which lever do you, what do you do?
So we actually have we have a document called our consensus statement, or the longer version is Statement on Longer Run Goals and Monetary Policy Strategy. And the 6th paragraph of that actually contemplates when the two goals are in tension. And what it says is, think about how far each variable is from its goal, and think about how long it would take for each to get back. So in a way, it's an equation. You're comparing two quantities, which each have two variables. And then you say, you look at that and you think, what do we need to do? And you know, typically this doesn't happen very often, but if one of them is further away, then you would focus on that one. In the case of high inflation, they actually both pointed in the same direction. The labor market was overheated and inflation was very high. So both of those called for, you know, for tight monetary policy. This could be different, but again, we're not actually facing that today.
I feel like there's another tension inherent in your job, which is that you're looking at the macro economy, at the global economy, really, and the U.S. places in it. But also the data you're looking at is very profoundly human, as Jim has been pointing out. Jobs, I think, and prices are probably the two most human pieces of data, and certainly in our day-to-day experience, probably the things that loom the largest. How do you reconcile those two things when you're looking at the data, like both the global markets and knowing that the data represents a lot of lives and jobs and egg prices and things like that?
So I think at the Fed, we always keep a focus on the people that we serve, and we know and are very conscious daily that the things that we do have a real effect on people's lives. We know that, and it really does focus the mind. And I think if you talk to people at the Fed, there's a very strong commitment to serving the public as well as we possibly can. Economic events are just very, very unpredictable at times, and there are shocks that you can't see coming. But nonetheless, our job is to, whatever happens, use our tools to bring the economy back to stability, back to price stability, back to maximum employment. And that's what we do. But you're right. We try to keep everybody in the room with us when we're thinking about what to do.
So in response to the last round of tariffs, Harley-Davidson, which is based in Milwaukee, moved some production to Thailand. Now the company might be whipsawed again by the new tariffs. It could be really devastating for sales, for employment, for the future of that company. But a lot of companies are in that same position. And what do you say to companies like Harley-Davidson and their workers?
So it just isn't, I really want to stick to our knitting. I mean, we have this great thing called our independence of monetary policy, and that's critical for us to be able to do our job. But for us to keep that independence, we need to not succumb to the temptation to want to be a player on issues that are not assigned to us. And trade policy is one of those. There are many, many issues that people love to try to pull us in on, almost every issue really. And we just need to stick to our knitting, not get pulled into those things. And so trade policy is a classic one. Energy policy is another. Climate change, many immigration is not really, although all of those things have economic implications, and it gets argued that way. But if we treated those as our job, the case for our independence would disappear. So I really can't comment on. I mean, we hear the same stories like that, but honestly, the policymakers who are charged with that, they're probably hearing the same stories too, and they're reaching a judgment about what's in the best interest of the country in the long run. That's what they are doing, I guess, and that's, so it's not for us to comment on that.
What happens inside the Fed at a moment like right now, when there's so much change and quite a bit of uncertainty, when you're watching things unfold? What does that look like, practically speaking? What are people doing inside the building?
So I'm very proud to work with the people I work with. I can tell you that in times like this, or times like the pandemic, where the global financial markets were shutting down, the global economy was shutting down, people step forward and they say, "We've got this." These are career people who were here for the global financial crisis. They've got 25 years, 35 years of experience with crises, and they step forward and it's just incredible what they can do and how good they are. It's a great honor to work with them. So right now isn't that situation. We have the situation we have. So, our trade people and our inflation people and our macroeconomists are all working hard to kind of digest the news of this week and try to filter that into the forecast that they'll make. And policymakers are doing very much the same thing. And we're reading everything we can about what's happening and lots of outside analysis too. We don't have an FOMC meeting until May 6 and 7. So that's really a process that lasts several weeks, and we're not quite at that stage yet. But we're kind of thinking ahead to that and working through all of that. I will say though, it feels like we don't need to be in a hurry. It feels like we have time to, yes, it feels like we don't. No, I mean, it's like I said, you have inflation is going to be moving up and growth is going to be slowing, but it isn't really, to me, it's not clear at this time what the appropriate path for monetary policy will be. And we're going to need to wait and see how this plays out before we can start to make those adjustments.
Question from the audience. One of our SEBU members is, are you in contact with other central bankers in other countries at a time like this?
Yes, pretty frequently. Absolutely. I mean, and the same was true during the other crises I've been through. Not only that, though, we do meet very regularly. The IMF World Bank meetings here in Washington twice a year. We go to Basel multiple times a year to meet. That's all central bankers. And there are also G20 meetings, G7 meetings where the central bankers are there. So we're kind of regularly meeting and talking. And when we're not doing that, we're also texting each other. And
is there a group chat?
I'm not at liberty to say. No, there's not.
And have you talked to those central bankers this week?
Recently, yeah, I didn't want to get too specific about this, but yes, I have.
What's their sentiment? Can you characterize that?
I'd rather, again, I don't comment on what my international colleagues say, or it's not appropriate. But we're talking about events. We're talking about the implications for the economy. We're discussing what we're hearing from markets and from business people and for from the elected governments too. It's all the things you would expect us to be talking about on a regular basis. It's one of the best things about this role is that the central banks have a lot. We're all non-political, so we think about things in quite similar ways, and they're real bonds. We're not lobbying each other ever on policy. That's just not a thing, because we do our policy here, they do their policy there. but we develop really, really good relationships and bonds with them. It's one of the real pleasures and benefits being able to talk about this, just not only with the great people at the Fed, but also with the leaders around the world.
I mean, it's interesting because it is a job of enormous responsibility and power, but it's also a job. Is it? I mean, how would you characterize the job of Fed chair? How is it as a job?
Honestly, that's what it is. I really feel just like another person doing that job.
Really?
Yeah.
You just like.
That's how it is. I'm doing a job. I have a job to do. I actually really like the job. I like it a lot. I enjoy it. It can be stressful at times. Nonetheless, incredibly interesting, great people to work with, really important. You know, what more could you want? But that's what it is. And, you know, again, I'm blessed by working with great colleagues who are really committed to getting it right. I mean, fully appreciate how important it is that we get it right and do everything we possibly can to bring the best thinking, the best analysis, and debate things, you know, over and over until we feel like we're in the right place. At the same time, there is no certainty in this. You can be wrong because the economy can zig when you thought it was going to zag.
So your term as Fed chair ends about a year from now. What do you think about your job security?
I fully intend to serve all of my term.
Excellent. I mean, as we're getting close to wrapping up, I did want to ask something a little bit out of the box. I think because you do have a position of such great responsibility, people are very curious about you, and I think people tend to read into everything a Fed chair does, small gestures, word choice. I know it's part of our jobs in this room to pore over every word you choose. I did want to ask about one thing that I've wondered about for years, which is your tie. You always seem to wear a purple tie, and every time I think I've seen you, you've worn a purple tie, and I'm wondering if there's significance to that.
It's this bad that they're asking him about the color of his tie. This is incredible.
They've run out of questions.
They've run out of questions.
The only significance was that I like purple ties.
Okay.
But I will say, you know, so then the next press conference, I reach for a blue tie or a red tie, and I go, maybe not, you know. And so I wind up wearing purple ties, and then it becomes a thing. And now I definitely wear purple ties all the time.
Okay.
But I felt like you didn't. It just felt a little awkward to be wearing one that was identified. We are strictly non-political. I can't stress that enough. We are not. It's not that we're bipartisan. We are non-political. We don't do that. And so purple is a good color for that. That's all. Plus, I like purple ties.
Sorry, I didn't give you a purple guitar pick. I have one other Milwaukee question that I overlooked here, but in Milwaukee and other parts of the country, the housing market is out of whack. In our market alone in southeastern Wisconsin, there's 5,000, the market's out of whack by like 5,000 houses that need to be on the market for it to have equilibrium. And a report this week said tariffs could tack on some $6,000 to the cost of building a new home. How long are people going to sit on their cheap mortgages from COVID? Thank you very much. And before they move on, before the market frees up.
So you have several things there. The first is we just haven't built enough housing, and we haven't kept up with the demand for housing. So there's an underlying shortage. Before the pandemic, you know, there was a real housing shortage. And by the way, that's happening in many comparable democracies around the world. The second thing is, you know, lock-in, as you say. There were very, very low mortgage rates during COVID, and people are kind of locked in. It would be very expensive to move, and that'll of course wear off over time. And you also mentioned, you know, the costs of materials that might be imported, you know, lumber and nails and things like that. And yeah, and also labor, a lot of labor from in the home building business has been traditionally immigrant labor. So yeah, the sort of new build market, it may face some cost pressures as well. That may very well be the case. That's what we're hearing from home builders, for example, both on the labor side and on the materials side. But even once these short-term things happen, we're still going to have not enough houses. And so it's all, you know, I think for a long time, we're still going to see upward pressure on housing prices, you know, maybe until population growth slows or until we catch up.
You mentioned that we're kind of in a period of waiting right now to see how policy ripples out through the economy. How long do you expect that to take? How long do you expect these big policy changes to show up in our day-to-day lives, in prices and supplies and things like that?
I mean, for a while, we didn't know what was coming on April 2. Now we know what came on April 2. We don't know. There's a lot more to be said about how all that shakes out. But we've come through that, and I think you now know that the tariffs are larger than people were generally expecting. That much you know now at this point. And you'll know more as you start to see the effects on the economy. So, as the months go by, it's hard to say exactly when you'll know. But clearly that learning process is ongoing. We're just seeing that these are new policies, not just the tariff policies, but the other ones as well. There'll be important fiscal legislation coming up fairly soon. And there'll be regulatory changes, significant regulatory changes. You have to really look at all of that to see what the overall effect will be. So I can't give you a date, but all of that is now kind of coming into place at sort of the speed you would expect policy changes to be. And then we'll begin to see the real economic effects as the year goes on. But again, I can't give you a really specific date.
Is the fiscal legislation the tax cuts?
Well, yes. I mean, I know they're contemplating, and again, we don't comment on fiscal policy, but what I read is that they're contemplating, making the Tax Cuts and Jobs Act cuts permanent, and also perhaps some other things as well. We wouldn't be. We have a sort of a placeholder for that too, but that's really not ours to comment on. But that's what I was talking about. Yes.
So I have a question from a friend in Milwaukee who said she has clients that have deals ready to go, businesses that are ready to launch from their garage to a private equity deal, and they're just stuck in their garage right now. How long do you think, what do you think the impact of the uncertainty these days will have on the private equity deals?
So again, we're hearing a lot of that. People are they're just kind of waiting for clarity. So, and I can't tell you when that will pass, but ultimately it will pass. We know that at a certain point we'll know enough to know what the uncertainty will decline, and we'll be able to see with real clarity what the policies are and what their effects are. So, you're right. We hear the same thing from businesses and from people that they're kind of waiting and seeing. There's a lot of waiting and seeing going on, including by us. And that just seems like the right thing to do at a time of elevated uncertainty.
What economic indicators are you watching right now? I mean, very famously, you look at the CPE and obviously the CPI and things like that. But are there any economic indicators in this moment, in these circumstances, that you are watching, focused on?
Sure.
Interested in?
So the basic two big data pools are the data around prices and around employment. And we get in the employment area, we get just really that's an area where we actually get pretty good data. Although the survey response rates have been lower, nonetheless, we get a lot of different data. And it's not just unemployment, it's participation, it's by age group and things like that. It's wages, it's many, many different things. It's jobs, it's quits, all the job creation, quits, openings, all those things. So that's one thing. On inflation, we target PCE, personal consumption expenditure inflation, not CPI, and the two are broadly they move they move together. But 25 years ago, the Fed switched to PCE. The public looks at CPI. It's kind of a little bit of a thing, but because we think it's really just a better way to capture the inflation, the cost pressures that households and businesses feel. We think it's a better measure, and that's what we look at. But they're not that different. I mean, they look at different measures. Ultimately, they're pretty close together. Those things, on growth, you look at what's happening with consumer spending. The economy is overwhelmingly driven by consumer spending. So you look at how are consumer surveys, how are they feeling, how are they spending? Sometimes the surveys are very negative, but they keep spending. That's been happening really for a while. People spent right through the pandemic, and they spent right through this time of higher inflation. They kept spending, and forecasters kept thinking, like us, that consumption would slow down. But that's a really critical thing. After that, business investment is a big chunk, and you look at that, and that is also susceptible to sentiment. You know, businesses, if they don't know what to do, they're not going to do an acquisition, or they're going to hold off on building a factory or a plant or hiring people, things like that. So we look at, I mean, I could go on for a long time. We look at a lot of data and we try to make sense. We also talk to people who are in the real economy. You know, I grew, my career was mostly in the private sector, talking to, you know, to people who ran businesses. And for me, the story doesn't come together until I actually hear from people who are in the economy doing things and what they're feeling and seeing. And then it sort of fits together better.
This is like via the Beige Book, or
The Beige Book, thank you for mentioning the Beige Book. And I hope you read it.
I love the Beige Book.
See, that's great. Everyone should read the Beige Book. The Beige Book comes out sort of mid-FOMC cycle, and it's all the 12 reserve banks and all of their incredible context, what they're saying about what's going on in the economy. So if you want to know, you know, you can look at the national data, but if you want to know what's going on in regions and at different industries, you look at the Beige Book. So it's really a critical thing. And actually, the reserve bank system that we have is an enormous strength of the Federal Reserve System. We have these 12 reserve banks with their own, you know, economics departments and own participants on the FOMC. So that's a great thing to look at.
I'd like to ask you about another body of work that many of us know that you're familiar with, and that's the Grateful Dead. So, question for you, sir. American Beauty or Terrapin Station?
American Beauty.
Well, it's not even a
Not even
pause.
close.
That was
Ask me a
so
hard one.
fast.
Working
No,
Man's
that's my era. That's my era.
Working Man's Dead
Yes.
or Europe 72?
Oh, both. Yeah,
come
that's
on.
my era. We're in the same era here. So that's, for me, it's late 60s to mid 70s. So
Touch of Grey, what do you think?
it was their only hit, but it's a good song.
Okay.
Yeah.
Finally,
We're going to do this?
I feel like you're speaking another language.
there's a well-known Grateful Dead bootlegger who, with the, I believe the permission of the band, Dick's Picks, who's put out. So what's your recommendation of those hundreds of?
I don't have any Dick's Picks. Like I said, my real interest was
What is going on here?
70s.
Why are they asking the Fed chair his music preferences?
Every song from that era, but since then I've been busy, actually.
Well, we thank you for taking time out of your schedule to join us here, and we appreciate your work.
Thank you very much. Thanks, everybody.
I think towards the end of it, asking about the purple tie and all this stuff, it's just because he couldn't give any real answers to their actual questions because he has no idea what to say for good reason. But all right, what was your reaction, Chris? What'd you get?
Nothing. He has to stay apolitical. I mean, and he basically told the Trump administration, go kick rocks. You know, like you want me to cut rates, get inflation down. The tariff thing that you're doing right now, it's not lowering interest rates. It's actually going to increase interest rates. So you want me to cut interest rates, get inflation down. That's it.
It's so funny because obviously if tariffs are going to be inflationary, he can't cut rates. And Trump is like, hey, it's time to cut rates. And he's saying, no. The tariffs you're imposing makes it harder to cut rates. So you go first, get rid of the tariffs. Then I might cut rates. But Trump's saying, no, we're going to keep doing the tariffs and force you to cut rates by getting the bond markets to come down. And it's just like this internal clash that we're seeing play out in real time.
Yeah, pretty much. Yeah.
Bitcoin right here, up 0.24%. Bitcoin's still green, but the S&P 500 down about 4% on the day.
Yeah, I think one of two things has to happen at this point. Either the Trump administration blinks and cuts, these tariffs a little bit, and that sort of helps, or the economy goes into recession, and then both of them are fucked. Where basically now the Trump admin has to take responsibility and say, look, our tariffs causes recession, and so we're going to roll them back. And at the same time, the Fed is going to have to basically, capitulate and be like, we need to start lowering rates, otherwise the economy is at risk. So both of them are playing chicken. Like the Trump administration is basically playing chicken with a lot of parties. They're playing chicken with the foreign countries with this whole tariff thing, and then at the same time he's playing chicken with Jerome Powell. On one hand, you're saying cut interest rates. On the other hand, you're raising tariffs. It's like, Yeah, no.
I mean, quite literally from this quote, he says it's not clear what the appropriate path for monetary policy will be. He even said in the interview, a year from now, we will have more certainties because the administration's policies will be in effect. But right now, we have no certainties. So are we gonna have to wait a year for Powell to actually understand what monetary policy looks like? Because as of now, and I think to his credit, he has no idea because no one has any idea on how exactly this should be played out.
Yeah, pretty much. I mean, like I said, the impacts of these Trump tariffs are not going to be known for at least maybe like 3 to 6 months. Because what's going to happen is all the companies that have inventory right now, they're going to be burning it off. They're going to be importing things. The tariffs haven't even technically gone into effect yet.
Yeah.
They're going to go into effect in April. So it's kind of hard to say what's actually going to happen. But economics will tell you tariffs are inflationary. So I think Jerome Powell just reminded him, indirectly saying, look, you're causing inflation. So, I know you want me to cut rates, but I ain't going to cut rates until you take better policy decisions. And the thing is, if let's say these tariffs, they stay and inflation starts to climb again, Jerome Powell is going to have the perfect out and saying, hey, I told you, you wanted to play that game of tariffs and now inflation is climbing again. It's your issue, not mine. And that's how it's going to be.
Yeah, the markets, whatever little green candle we got before Powell spoke, I don't know what that was about, but it obviously had nothing to do with what Powell was going to say, because everything he said was hawkish. And again, I don't think we can blame Powell for being hawkish. He's just not biting first when it comes to cutting rates. And if him and Trump would have at it, then it is what it is.
It would have been worse if if Powell was dovish.
Correct.
Okay,
yeah.
that would have been worse, because then it would have been signaling to the market that there's some underlying issues with the economy that could be tanking, and they have to basically cut in order to save the market. Right now that doesn't seem to be the case. So they basically, just said, listen, we're not going to say either or. We're going to leave it up to you to make those policy decisions, and then based on your policy decisions, we're going to react. So this really puts things into perspective for the Trump administration, where I think they're going to have to capitulate, dude. I don't see any way around it. I think the next week we could see more of this, where basically, we see a little bit more volatility. But at this point, it's all on the Trump administration, and what's his name? Powell is like, you're not going to put any blame on me. I'm not the one to basically cause this inflation. It's you.
But he's right. Let's say the economy does crash. Does anyone blame Powell?
No.
I think no one blames. Everyone blames Trump.
Dude, it is Trump.
One, you could blame Powell, but not this time around.
It's 100% Trump's fault if the economy falls into recession. And I think Trump will probably end up putting it on Lutnick. But I don't think that Trump is, for all the things I know Trump is, he's a pragmatic individual. So he basically bet on Lutnick. The market reacted very poorly, in which case now he's gonna basically, say, you know what, maybe Besant was right. Maybe 10% is the way to go, and basically change policy to ease up on some of the tariff things, and basically, do the negotiating and take the small wins. I don't think that Trump can sustain the tariffs for an indefinite period without causing long-term stability issues. And I think every CEO is going to be reminding him of that during the next quarter, where every CEO is going to be coming on the, what is that thing called? On the earnings call and being like, we're revising our guidance, or we're not giving guidance for the end of the year because of uncertainty around tariffs, and that may end up cratering stocks, but at least it'll get the people to realize that, wait a second, the market is, not happy with how the Trump administration is proceeding with what they're doing. So I'm hoping that they're smart enough to basically roll back a lot of this stuff before April 9th, right? Or delay these tariffs, and basically say, like, a bunch of countries have reached out to us. We're going to be delaying this tariff implementation for another 60 days or whatever, and then work on work on basically bringing more confidence into the market. Because right now, I mean, dude, 2 days back to back. Let's see, CNBC. What is this? Yeah, markets are down another 4%. Like Nasdaq's down 4, S&P's down 4. We're almost
That's basically 10% in 2 days. I mean, around 8.2% in 2 days.
Yeah, that's pretty substantial. You know, and no one's buying the dip because no one knows what Trump is going to do.
Yeah, this is
Liberation Day. Liberation Day turned out to be liberating. It ended up being what everyone was joking about, which is liberating me from my money.
Liquidation Day.
Liquidation Day. Yeah. All right. Well, I'm gonna
I'm gonna end it right here. Yeah. Thank you everybody for being here. Appreciate you, Chris. Deeply appreciate you spending the past couple hours with us. Chris's Twitter, I'm putting right here in the chat. Your analysis on a day like this was very well appreciated. I will be back for the market close, guys. We might start early. Potentially, we might have Dan Ives on the close. So you guys will just see if we do start early, it'll be at around 3 o'clock, or sorry, around 3:30 instead of 3:45. If not, then we'll start at 3:45.
To everyone, good luck on your portfolio. I would probably just look. The worst thing you could do right now is sell, especially if you have a great company who you know is making money, that's going to be growing for the next 5, 10, 15, 20 years. If you have dry powder, if you have areas where you can drop liquidity, right now is the perfect time to be figuring that situation out and making sure that you have enough capital to really buy the dip. So, yep.
All right. Thank you, everybody. Appreciate it. I'll see you guys in the market close. Bye, everyone.